This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. And I want to say, before I say good morning, introduce my co-anchors, etc., that we are getting ready to celebrate the 77th year of independence, 15th August, tomorrow. And I must say that we begin this with a renewed sense of optimism where, dare I say, even sky is not the limit. We are counting down to landing on the moon. Guys, morning.
Hi, good morning. And it's the kind of session you like, right? You come out of a holiday, you get into the holiday, you're feeling all patriotic. It just feels right and optimistic. I think that's the perfect way to summarize
You know, though we are feeling very, very good, I'll tell you what, the kids are feeling great because they're just going to go in today and they're going to get 2 days holidays. My son was thrilled out of, because they're dressed up in the Indian attire and they're saying, we're going today, but 2 days we're off. So, but, not to forget, with all this independence celebration as well, we remember the great man today, Mr. Rakesh Chunchunwala.
Yeah.
First death anniversary, so strength to his family. And if you're looking for inspiration, well, today is the day, first death anniversary. Strength to his entire family, actually. The man who lived his life, investing in the stock markets and the biggest bull that we've ever seen in the Indian stock markets as well.
Always optimistic, always cheerful, never seen the man down.
Yeah.
And I think, as you said, Nigel, an inspiration, I think. And I think the newspapers this morning, yesterday, I think it's absolutely correct the way, tributes are flowing in and tributes are being paid. So I think we'll talk about this and the legacy and what from here and, the portfolio, of course, etc. It's, in a way, public information. All right, well, let's just kick off the day with what you need to know as we start another trading session, right? This is a new week. So let's begin with where we left off on Friday. On the market, we did not leave off on a pretty good note. Friday's fall is leading to some amount of nervousness, and I'll tell you why. Because global markets are also, in a way, looking a little sort of naughty. They're looking a little naughty with the K. They're looking a little out of sync. The Nasdaq ended about 0.56, 0.6% lower on Friday. U.S. Treasury yields are higher. So they went up. Dollar index is almost at 103 kind of levels. What this is doing is, and by the way, the Treasury yields are the problem. The dollar index rising is the sort of derivative of what's happening to Treasury yields, and it's kind of causing a fair bit of damage to currencies around the world, emerging market currencies around the world, which are facing the heat, which are under pressure. So I would say that the global setup perhaps is looking a little tricky as we start another session this morning. So Nifty, just to get back to levels and how you need to kind of approach this, it broke on Friday below the swing low of 19,467. So we broke that and we ended below it marginally, but we did that. Now, ideally, I would kind of say that we've got lots of supports coming in between the 19,300 to 19,400 level. This 100-point zone has got lots of supports. There's a 61.8% retracement of a rise. There is a important moving average. And there are Bollinger Bands, daily Bollinger Bands, etc. as well. So this 100-point range ideally should hold. If you are looking for one number, right, as a kind of a marker between what the market does over the next many sessions, I would go with the 40-day exponential moving average. That comes in at 19,352, bang in the middle of that 19,300 to 19,400 range. So, take that as a support, at least in the very near term. You get a close under it, and I think you'll start to see more downsides coming in. If this zone goes, the next supports only come in around the 19,150, 19,200 level. So again, all nearby, not very far away, but that's how things are looking right now. On the upside, we need to close above the 20-day moving average on the Nifty, which now stands at 19,657. So those are levels on the Nifty, both on the downside and upside. Bank Nifty broke just to similar levels on the Bank Nifty, broke below the swing low of 44,513 on Friday. Here, the support for the Bank Nifty comes in at 43,933. Which is basically about 1.2% away from where we left off on Friday. On the way up, the Bank Nifty needs to close above the 40-hour exponential moving average, which comes in at 44,667. Here's the point. I would say this. You come back today. Tomorrow is a holiday. And day after, schools are shut. Trading activity, etc., is going to be a little thin through the course of this week. It's also summer markets and globally speaking, so volumes are lower, so price moves can be exaggerated. And in any case, as I began by saying, things globally are looking a little tricky. Let things resolve itself, and then I think we get the next leg, whichever direction it is. So keep these markers in mind in the very near term, and I think that will tell you what you want to do. Sit out if you are not sort of compelled to put in a trade or two. Let the market tell you what it wants to do, because we are entering a bit of a flux kind of a zone. The implied open is indicating a 80-point lower start. Rima.
Well, it's gotten worse, right? At about 7 o'clock, the implied open was down 55 points. And now it's extended the fall a bit. But just quickly, let's get you up to speed with the global headlines. Now, U.S. markets had a mixed finish. The Dow managed to close up in the green with a gain of about 0.3%, but the Nasdaq slipped. The Nasdaq was down 0.7%. That's the tech-heavy index, and it's posted 2 consecutive weekly losses for the first time this year in 2023. The inflation data coming out of the United States is a bit mixed. Last week, we told you how the CPI inflation positively surprised. Well, on Friday, we had the producer price index, which measures it at the factory. And that came in higher than what the street was anticipating, and that dented the sentiment a bit. The Chinese economic data continues to be weak. So over the weekend, we got the credit data out of China. And new loans in the month of July are the lowest that we've seen since 2009. So the economic data coming out of China continues to be gloomy. Last week, it was the inflation turning into disinflation. We also had the weak trade data. Now compounding the problems is the credit data out of China. The Indian macros, today at 5:30 p.m., India's CPI inflation print will be out. It's estimated to be a figure above, at the upper end, given the way prices have inched up. And plus, you've got the June IIP numbers, which the street will react to. It's coming in slightly lower than what the street was anticipating. In terms of flows, the FI sold about 3,000 crore in the cash market. The selling in the month of August has now hit 7,500 crore from the foreign, FIIs. And after buying in the Indian markets for 5 consecutive months, August has firmly been about FI selling in the cash market. The big earnings today will be ITC Divi's Laboratory, but with that, we'll mark the end of the earnings season.
Well, that's right, Rima. Great news, right? It's been quite a gruesome one. So end of earnings season. But how do I see trade set up today? Well, the dollar index is showing strength. I'm a little worried about that front, because all odds were that maybe we get past that 100 odd and we break down. But actually, we're seeing a bit of an up move, which is a little bit worrying from an India perspective. So that's point number one. Second factor is the domestic participation, well, for the next few days could be a little bit subdued. So just keep an eye out on volumes on that front. But how are the FIs positioned? Well, in the FNO market in particular, the index futures, well, the short positioning on the entire index futures is close to around 60% approximately. On Friday, they added shorts on the Nifty Bank. Close to around 4% open interest built up is what we saw on the short side from the FIs itself. So they're shorting the Nifty Bank in particular. On the Nifty, there wasn't too much movement. On the index option side as well, there's a bit of a bearish skew coming in there. And they are believing that the markets are not going to get past here, maybe the 19,600 odd mark, because they wrote calls and they wrote calls aggressively, more calls written than puts. Now, today is the Nifty Financial Services Index expiry. Normally, it's on Tuesday, but Tuesday we're shut. So today that will play out as well, which brings us to the Nifty Bank. The question is, the Nifty Bank has been weak. Now, which way is it going to swing? It's pat in the middle. Can it make a bit of a move towards the 50 DMA? As of now, the likelihood is more that it maybe slips down to around the 100 DMA, because it's been showing some weakness. So we're pat in the middle. We'll have to see how this moves. On Friday, in fact, we had the lowest close since the 26th of June. So the Nifty Bank clearly is the one that's seeing some pressure. Well, you got a couple of strikes that are quite active as well that come up for you in the screen, the call as well as on the put side. So the range is on the downside, for the day at least. The 43,900 odd mark, you'll want to watch that on the downside. While on the upside, it's likely to see some bit of selling. But if you're looking for a number, well, that comes up for you on the screen. And I'm looking at the 43,900 mark on the downside, because the highest open interest is at around 44,000 put. So just keep an eye out on that one. Nifty, 2 strikes very active. 19,500 call, that was getting written in Friday's trading session. But on the downside, you got the 19,400 put as well that's fairly active, which brings us to 2 important levels. The 20 DMA, well, that's been a little bit elusive. We went there a couple of times. We couldn't get past that. But you have the 50 DMA. That's going to be crucial on the downside. So 19,250 to around 19,300 becomes a crucial support zone. That's the recent low as well as the 50 DMA. For starters, we pull back. Let's see how this goes. But otherwise, the Nifty Bank, that's the one to track. Can it have a bit of a relief rally is going to be the big question.
All right, we'll kind of pick up from there. That's the setup as you need to know it. Well, before we go any further, let's quickly tell you what's lined up here in the first half hour of the show today. We get you updates from markets around the globe. Mark Matthews of Bank Julius Baer and Company will join in to discuss the global setup. Our research team gets you the top 10 stocks to watch out for a little later after that. And Prakash Diwan will talk about stocks and things he likes this morning as we start another day.
Let's get you some money market views then. On the rupee, B. Prasanna of ICICI Bank says U.S. yields hardened. The dollar continued to strengthen after the U.S. PPI data surprised on the upside. Risk-off sentiment and Chinese yuan depreciation on the back of weak economic data led Asian currencies weaker. The rupee traded with a depreciating bias near the upper band of 82 to 83 against the dollar. For this week, he expects the rupee to trade within 82.5 to 83 against the dollar, with the RBI protecting from sharp depreciation.
Okay, well, we got B. Prasanna weighing in on bonds. He says ICICI says that the U.S. yields hardened last week as massive supply took its toll, taking global yields higher. Back home, NPC maintained status quo on rates, but increased cost of liquidity by introducing incremental CRR, which led to hardening of yields across the curve. He expects bond markets to remain under pressure with a 10-year benchmark yield trading in the 7.1 to 7.25 range.
Well, we have a lot of stock-specific action track for you, and we'll get to that in just a bit in our special Top 10 segment. For the time being, we run you through the list. We're looking at ABB India, ONGC, Glenmark Pharma, JSPL, NMDC, Muthoot Finance, and Nykaa. All of them will be reacting to results and positive news flow over the weekend. While on the flip side, you have Patanjali Foods, Amara Raja Batteries, and Voltas that we're tracking on the negative side.
Okay, well, Mark Matthews of Bank Julius Baer and Company is now joining us to take us through what he's making of things. Mark, good to have you with us here. Thanks very much. You know, the 10-year in the U.S. is back at about close to 4.2. You've got the dollar index rising a little bit, 103. You've got oil prices, which are looking like they want to go up, at least not down. Is the global setup looking a little tricky, even as, on the economy front, things are looking just fine? Even in the U.S. Go on.
Prashant, yes, I concur with what you said, and I would add to that we're in the dog days of summer, so we're paying back for those exceptionally strong numbers that we had in June and July. The volumes are thin in the market because many people are still away on holiday. The results are largely behind us, and the results season, although on average companies beat expectations, we can see that the market was nonplussed with that because going into the results, expectations were very low. And I just don't see many catalysts going forward. So to add on to what you said, I would state those things. And summing it all up, I think short term, we're more likely to drift than go up.
How would you determine short term? Do you think it's going to last 1 or 2 months? What would be the trigger which will get us out of this range?
There could be all sorts of triggers, but if I had to choose one thing which is responsible for the market pullback, I think it's the strength of the U.S. economy. And we're likely to see a continuation of strong numbers. Most notably, the July retail sales will be announced tomorrow. And I think the market is only looking for a 0.4% month-on-month increase, excluding autos. But looking at more high-frequency data, it could be as high as 0.7% month-on-month. So the strength of the economy is why bond yields have risen from 3.8 to, as you pointed out, 4.2% over the last 30 days, and the dollar has strengthened. And until we see signs of the economy ebbing, I think the market will increasingly take the view that rates are going to stay high well into next year.
All right. Hi, Mark. Good morning. Since the U.S. economy is so strong, then you believe that the Fed will keep rates higher for longer and no chance of a cut. So I wanted to comment on how do you see the Fed moving from here? And the second point is, since we had our RBI policy last week, it was viewed as a bit of a hawkish pause. How did you read it?
To be honest, Nigel, I was on holiday last week, so I can't respond to your question on the RBI.
So let's talk about the Fed then.
The Federal Reserve. They are data dependent. So if this data does remain so surprisingly robust, then I think it is safe to assume that rates won't come down until well into the middle or even second half of next year. I suppose the only good thing to say is that it shows the strength of the economy that you can have a 5% rise in interest rates and skirt a recession. I actually think that on the whole, it's a positive signal, but higher rates, of course, do mean that there's greater competition for the stock market than if, interest rates were trending down.
Mark, that's the big question, isn't it? Can you have a situation where, it's so easy that there is no price to be paid for the biggest inflation surprise in the U.S. in the last 50 years, and it all goes away very neatly, very nicely, or you think, it'll be something else by the end of the year?
Well, you may have seen these research reports that have been coming out showing that even if we trundle along at 0% month-on-month increase in the headline U.S. CPI over the next 6 months between now and say the end of the year, even if we assume flat month-on-month CPI, which it won't be, it'll be positive. You'd still have the headline CPI on a year-on-year basis, something around 3.5% by the end of this year, which of course is well above what the Fed's 2% target is. So I think that the inflation is sort of getting sticky here and less likely to continue its downward trend. I guess we had all been anticipating inflation to come down because we thought the economy was going to slow down, and that's simply not happening.
Mark, pleasure having you here. Thank you very much for joining in. We need to get into a very short break. On the other side, we'll talk about stocks. Our list of top stocks is lined up next. Welcome back. The GIFT Nifty is suggesting that our markets could open in the red for the third consecutive session now, currently down close to about 73 points. What about individual stocks? Our entire research team is standing by, dressed in their finery, for CNBC-TV18's top 10 list of stocks for the day. Good morning, everyone. Vivek, let me start with you on ABB.
Well, that's right. Post the results of ABB Global and the commensurate commentary, a few concerns had emerged as to the order inflow activity as far as, the Indian operations were concerned. But post the results, all of those concerns have been put to rest. Very strong set of results, strong double-digit growth in terms of revenue as well as profitability across all of the segments. Now, and, it's also a significant beat across the poll. Now, revenues largely in line, coming in over the 2,500 crore mark, up 22% on a year-on-year basis. But the core EBITDA is where the big part of the beat has come in. EBITDA stood at 348 crore versus our estimates of just around 306 crore, a significant beat there. And the EBITDA margin came in at 13.9% versus an estimate of 12%. So strong margin expansion too happening. Along with that, profitability too, above estimates, 295 crore versus our estimate of around 247 crore. What are the margins aided by? Margins were largely aided by better operational efficiency, cost optimization, as well as improved price realizations. Talking about the order strength, the base orders grew just around 4%, but one large order win in the metal segment is something that aided the order book this time around. Strong set of results from ABB, going with the green on this particular name.
Okay, all right. Thanks a lot for that, Vivek. So green on ABB. Well, let's hop across to Sonal. She's here to tell us about ONGC's numbers. Morning, Sonal.
Good morning, Nigel. Well, green for ONGC as well because it was a top-down beat versus our poll and a good recovery that we saw on a sequential basis despite the fall in crude oil prices. Revenues were down 6.8%, but EBITDA was up 49.5%, leading to a margin number of 57.5% versus 45%. Profits also came in at 10,015 crore rupees versus a poll of 8,400 crore rupees and a big uptick on a quarter-on-quarter basis as well. Crude oil realization after the windfall taxes that the government levied came in at $73.6 per barrel, largely in line with what the street was working with. CLSA has a buy rating with a target price of 225 rupees per share on the stock. They say that the company guided for liquid production to start from their KG D6 basin. This is in next 3 to 4 months itself, one of the blocks there. So if this comes on stream, it could add 12% to ONGC's current domestic oil production and 20% to gas production at peak levels. So that is a positive commentary that we got in. Expect the stock to do well in trade today.
All right. Well, I think Morgan, this morning has put out a note as well on ONGC. We'll discuss that greater detail as we go on. Thanks very much, Sonal, for that. Glenmark Pharma is the next one, was reported. Ekta's got details. Ekta, morning.
Thanks for that. I expect that stock to be in the green today. Revenue up 22%, margins at 18.5%. Street was anticipating 18%. Profit of around 150 odd crores. That was lower because of finance costs as well as depreciation. India was up only around 2.8% year on year. That was because of divestment of brands, the NLEM impact. But the US sales did better, $98.4 million. It improved on a year-on-year basis. And it was largely a little lower than what the street anticipated. But Europe was very strong, so it was up around 73.7% on a year-on-year basis. Now, the reason I'm going with green is because of the stronger revenue growth. But do remember that the stock is already up 1.2 times from its 52-week low, is just about 4% away from its 52-week high. Also, the earnings call is at 9:30 a.m. So the trajectory of this entire piece could change once the company does talk to analysts.
Okay, all right, Ekta, thanks a lot for that. Well, I'm watching two stocks, JSPL as well as NMDC. Let's start off with JSPL. The only problem with the numbers, it seems, the street sensed it. Because on Friday's trading session, well, the Nifty ended virtually at the low point of the day, but JSPL ended at the high point of the day. So it seems the street was really, sniffing some good numbers. Anyways, that's about the stock price move. But on the numbers, well, on the top line, there was a marginal miss out there. That's only because the volume growth maybe was not as much as expected, very, very small. But just take a look at the big beat we're seeing on the EBITDA front. EBITDA and margins looked very, very good. The key reason out there for the beat was realizations were up by close to 100% on a sequential basis. They had 10% of their sales volume as exports, and that gave them better realizations. So that was one of the reasons the street was working with a bit of a contraction. The management says as well, bulk of this EBITDA improvement came in because of the cost initiatives, and they got the benefit of lower iron ore cost as well as some part of lower coal cost as well. The standalone EBITDA per ton, well, the street was working with a number of around 11,000 rupees. It's coming at around 14,400 rupees. So that's clearly a big beat out there. And to add to the good news, the net debt level has come in its lowest we have seen in the last 15 years. It was down marginally even on a sequential basis. The PAT number, by the way, looks much better, but that's because the tax was effectively lower. Moving to NMDC, those numbers as well were pretty good. The top line, the EBITDA number as well as margins, well, they looked quite good. And it's a top-down beat out there, but just marginally so. The reasons for that is volumes numbers we almost had with us. That was up by close to around 40%. But realizations on a sequential basis were up by close to 4%. Royalty on a per-ton basis and other expenditure on the per-ton basis were down between 20 to 30%. So explains why the operational performance as well looked much better than what the street was working with. Expect both these two stocks to open up in the green. But let's get back to Abhishek. He's standing by to tell us about Muthoot Finance. Abhishek, morning.
Morning. So for Muthoot Finance, the gold portfolio is shining this time around. AUM growth on a YY basis at 19.3% is perhaps one of the best in last 8 quarters, and a 7% sequential growth is seen. Gold AUM growth is about 17.5% YY and about 6.7% sequentially. Calculation shows that the average gold loan, which is there in terms of ticket size, has grown by 12.35% YY and 5% sequentially. This indicating that the higher gold price has driven the gold AUM growth this time around. Asset quality, slight hiccup over there, which is seasonal in nature. Net interest margin has come in at 11.58% versus 12.26% in the previous quarter. Operating profit growth is strong at 36.75% YOY and about 8.5% sequentially. However, on the flip side, the home finance subsidiary, the capital consumption is pretty strong or pretty robust over there, which is a negative sign. It is coming at 52% in terms of capital adequacy ratio, which was at 66% in the previous quarter. And in terms of Bazaar MFI, their performance is also strong. The AUM growth is more than 49% YOY and about 13% sequentially. Back to you.
All right. Thanks very much, Abhishek, for that. Well, Muthoot is going to be in focus. Well, Nykaa and Patanjali are next on our radar. Mangalam has got both of those. Mangalam, morning.
Good morning. So Nykaa, steady performance coming in for their beauty and personal care business. Decent growth out there as well. The fashion business is struggling for them, and that's something that we've seen in the likes of ABFRL as well. So some distress in the consumer sentiment when it comes to fashion. Good growth coming in their other smaller verticals on account of a low base. So if you just take a look at revenue, 9% growth quarter on quarter. There's a 4% jump in the EBITDA. Margins at around that 5.2% mark. The net profit has increased, but that's on account of certain exceptionals, where the tax expense has been lower and the loss in associate also has been lower as well. Year on year, it's a 59% jump in their operational performance, so that's good. Total gross merchandise value growing by about 24%, and most of that being led by beauty itself at 24%. See some green on the stock. Patanjali, however, will see some red, and that's largely because there's been a sharp contraction in their margins. Understandable because of the correction that we've seen in oil prices, and edible oil business has reported an EBIT loss, whereas the food and FMCG business, which has the company's focus, has continued to grow upwards of 200% itself. 7.7% overall revenue growth. The net profit, however, has declined by 64% on a decline of almost 55% in their EBITDA.
Thank you very much for that. Today, Nomura has downgraded Nykaa to a neutral. They believe the margin improvement trajectory at Nykaa has been slower than what they were anticipating. The ad spends were also slower as D2C brands spent less and the launch of a new platform. So their target price is at 163. I'm also looking at Amara Raja Battery, where the earnings were below street expectations. The company's clocked in a mid-single digit top-line growth of 6.6%. It's also slower than the revenue growth that it's seen in the prior quarters. In the March quarter, the top-line growth was 11.4%. The quarter before that was 11.5%. So from a double-digit growth, it slowed down to a mid-single digit growth. Margins have improved on a year-on-year basis, but again, less than what the street was anticipating. So operating margins at 12.6% falls short of a Motilal Oswal estimate at 14.4%, and also sequentially, there is a margin contraction. So that's the reason why the profits have also missed what the street was anticipating. So negative set of numbers coming in from Amara Raja. But the other one on our radar is Voltas. Surbi joins in with more. Surbi.
Thanks so much for that. So it's a mixed bag for Voltas. Now revenues are way above expectations, but the miss was on the EBITDA and the margins front. Revenues were up 21%, almost 13% above the poll. The gross profit margins saw an expansion of 60 basis points. EBITDA was up nearly 5%. Margins came in at 5.5% versus 6.4% same time last year, but a poll of 7.4%. So a disappointment on the margin front. In the cooling product segment, the revenues and the margins were a surprise. The revenue saw a growth of 16% and margins were also up 50 basis points. But the disappointment came in on the AC market share front. They've lost 130 basis points in the AC market share, came in at 20.6%. The EMP segment, the revenue growth was strong, about 49% on a year-on-year basis, but the losses continue to expand. This is the fourth out of 5 consecutive quarters where the losses have expanded. So that's a key monitorable for Voltas. A completely mixed bag, but I'm going with red for now.
Thank you for that. And here's a quick recap then of the top stocks today. Stocks with positive news flow are ABB India, ONGC, Glenmark Pharma, JSPL, NMDC, Muthoot Finance, Nykaa, while stocks with negative news flow are Patanjali Foods, Amara Raja Batteries and Voltas. We've got a lot of other stocks that we'll be talking about, like Adani Ports, but for all that in just moments from now. Right now, let's go across to Manisha Gupta for a complete roundup of all the action from the commodity space. Manisha.
Well, thank you so much for that. Well, I'll start with the crude oil prices, which have posted 7 weekly gains, and we have seen the crude oil prices gain up by 20% in last 7 weeks. This week has started slightly on a lower side, and that is because the markets are awaiting very important economic data. Tomorrow, you have the China industrial production as well as the retail sales numbers coming in. So ahead of that, there's a bit of a choppiness into the markets. What also is trading under pressure is the overall metal sector. So the gold prices, after trading 3 weeks on the weaker side, are trading at a 1-month lows right now. Zinc is trading at a 3-week lows. Iron ore prices have declined to a 2-month lows. Even copper is trading at 1-month lows right now, even as the structural fundamentals are strong, because we've seen inventories continue to decline. But because of the weak economic data coming in from China and expectations that with the higher inflation, you could be looking at another rate hike from US are some of the factors weighing onto the markets right now.
Okay, all right, Manisha, thanks very much for that. We'll take a quick commercial break here. Up next, we have Rakesh Devan joining us, Prakash Devan joining us for a quick fundamental stock check. We'll discuss some of these earnings which our research team put out and, of course, what he likes in them. We'll also connect with Sanjay Thakkar of Landmark Cars. They reported a pretty poor quarter, Q1. So stay tuned. Those conversations come up next.
Welcome back. Hope you're having a good morning. Well, we just told you all the stocks that we're tracking in our special top 10 segment. Let's analyze a couple of those numbers. And Prakash Devan joins us to help us analyze some of those. Hi, Prakash. Good morning. Well, let's start off with JSPL. In Friday's trading session, the stock ended at the high point of the day. It seems the street was sensing that these numbers will be very, very good. And boy, weren't they good. But how much of the good news has played out already? Or do you believe there's still scope for the company to do well? And I ask you this because prices are a little bit weakish post the Q1 numbers. And also some of their capacities that are coming on stream could be a little bit delayed.
Good morning, Nigel. So you're absolutely right. The numbers probably, if you look at them, especially the standalone ones, they give you a very different picture than what the consolidated basis picture looks like. But what's interesting is that the market expectation that within a sector that's probably weak and hence not richly valued or kind of, overbought, you had certain companies which could probably deliver superior performance. And this is one of those examples. I mean, we've seen that in Tata Steel as well. I mean, I'm a big believer in the fact that all the steel companies that survive this low or low phase in terms of global, prices are very likely to start reaping the benefits of capacity expansion and efficiencies that they've built over the last few years. So whether it's a balance sheet, repair with Tata Steel, that JSP has also deleveraged itself to a very large extent. And now you have the expansion on the Angul mines, which would probably start helping them out as well. There has been a delay in some of their business expansion, but I think what's important is the economies of scale that they have achieved is going to hold them in good stead. Don't expect anything spectacular today, at least, because the stock had run up and the numbers are not so promising as yet. But it does tell you that the company is ripe for a re-rating in the long run in the next 3 to 4 quarters. And that's something which people will have to take very positively in terms of a portfolio reshuffle or something.
Prakash, any of the stocks that you own reported numbers over the last 2 days? How did it fare? Does it change your narrative, both positive and negative?
No, so, to be honest, Rima, it's the result season is very clearly indicating that the last phase of earnings is always tending towards the weaker side. Yeah, I mean, we've seen a lot of numbers that have been weak. One of the stocks that I track closely and which has been a bit of a disappointment has been Timken. Everything was probably good, but then this whole softness in demand, which has precipitated that closure for some time, which they've informed the exchanges, does kind of, start making you question things. But of course, you also have to put this in perspective that the plant that they're talking about closure does not churn out very high value add products. It's a very basic facility. Most of the stuff that they supply to the railways and to the wind sector actually from other facilities. So that's likely to be taken a bit, in a more moderate way than what it optically sounds. Apart from that, I think the numbers very clearly tell you that interest rate costs are hurting companies, and that's where the margin is getting into a little bit of a question. But there were some Suprajit likes, the types of Suprajit which did well both on the revenue and on the margins. So I think certain pockets will do well because of the kind of tailwinds that they've had in terms of comeback of demand on the ancillary side and things. So today there's a company called FM Industry that I track, which could probably be interesting to look at. So you have certain companies, but very few, Rima. It's not something which is giving you a trend. But on a bottom-up basis, there are certain numbers that probably will be worth looking at. And of course, the big daddy ITC is what we are watching out very closely for today.
2 names, Prakash. Hi, good morning. One is Astral, which reported numbers. I don't know if you have a view there. CLSA this morning has come out with a downgrade, I think largely because of valuations. But this comes after results. And the second is Muthoot Finance, where numbers are decent. And stock has seen some repair after languishing its back up to a more respectable kind of zone. And management has sounded confident for the last 3 quarters at least now.
No, absolutely. Good morning, Prashant. So I think let's take Muthoot. Muthoot is a company that's kind of transitioning itself and de-risking itself from a dependence on the gold portfolio. I mean, you have so many, the microfinance business, you have the home finance business. So there's lots that's moving for them in terms of coming together. The gold yields have been far better because of the fact that prices have been higher, right? So their AUM would definitely have an organic push into that. And to me, Muthoot numbers or even the Manappuram numbers tell you at what stage of growth is the economy in and which segments. It's a very strong correlation. When gold loans go up, it's usually, the informal sector or the not so formal sector that actually is rapidly growing. And then the demand for credit is percolating into gold loans. So that's a very clear indication, which doesn't seem to be the case in this quarter at least. But I think what's working for Muthoot is that it's probably far more superior and balanced as compared to its closest competitor in the listed space. So that's the reason why you probably see more inflows. If you had to allocate money to a gold loan company, probably this becomes a choice by default, and you don't have any confusion between this and Manapur.
Prakash, would request you to stay on. It's time for a first corporate interaction today. Landmark Cars, which is a dealer of premium automotive companies like Volkswagen, Jeep, quite a few of them. Mercedes-Benz is a big one, is a big OEM that they are retailers too. They reported their Q1 numbers, and it was a weak set of numbers. Revenues have fallen by 13% on a year-on-year basis. The revenue decline was due to the unavailability of multiple high-selling models. Discontinuation of a few models also led to a revenue decline. The margins have been largely stable at 6.4% versus 6.2%. Profits after tax declined by nearly 60%. We're now joined by the top management at Landmark Cars to discuss the way forward. So let me introduce Sanjay Thakkar, chairman at Landmark Cars. Sanjay, morning, and thank you very much for joining in. Now, Q1's been weak, and you've articulated the reasons in the press release for that. Can you give us an indication how Q2 is going to be? Is it going to be similar, or are you now seeing the availability of higher selling models? What can you guide for Q2 and the second half of the year?
Yeah, sure. Thanks for having me. Let's start with the good news first. The demand continues to be there for premium and luxury automotive. The market is clearly shifting towards them. And the numbers indicate, the industry numbers indicate that the demand is still there. There was some concern in people's mind that this was a pent-up demand and it would kind of taper off. That is not happening. That's the first thing. The second thing to know about the auto retailer, which we are and which people should understand, is that we work in, we have two segments of business. One is the after-sales business, which is more like an annuity type of a business, the more predictable part of the business. And then there is the sales business, which is dependent on the OE, the new models introduction, the supplies, and we are completely dependent on that. And it is difficult to predict quarter on quarter how the supply situation would be, new model introduction would be. So what happened to Landmark in the first quarter? As far as the after-sales high margin, 40% gross, 18% EBITDA margin business is concerned, which has been growing at 20% CAGR for the last 9 years, that growth continued. In fact, we increased the per car revenue that we generate to 24,000 plus rupees, which is a jump of over maybe 9 to 10% over the same period last quarter. So that business continues to be stable and doing as well as everybody wanted. As far as sales is concerned, clearly we had a challenge in supplies. And what supplies am I talking about? Let me give you one or two examples to kind of detail out this point. Honda India had a 37% decline in their sales because the Jazz, the WRV, the diesel versions were not available for sale from April. How is the situation going to go better? The Elevate, which is the SUV, which is what we are all looking at, is getting launched in the first week of September. And suddenly you will see the Honda numbers doubling from where they are. GLC, Mercedes GLC, which is the global bestseller. It got introduced in India only last week. And the company has seen more than 1,500 bookings all India, which translates into, I don't know, around 1,100 rupees of sales. And we are their largest partners. So this will percolate down. The first quarter of Mercedes-Benz has seen an 8% growth. My sense is that since the company is guided at a high double-digit growth for the year, the rest of the period is going to be significantly better. So to answer your question, there are the sales aspect, which will start kicking in from August, September onwards. Things will significantly improve. The after-sales business continues to be a backbone and something which we can predict very happily. So this is what is happening. Our MG Motors operations in Madhya Pradesh also started operations in August. So a lot of things which are good are in the pipeline and have already happened.
All right, Sanjay, you've given us quite a bit of inputs out there, but we're running a little short on time, and it's good to hear that demand for premium cars is going up. I'm struggling to buy my new bike, but good to know that you're seeing a lot of traction on ground. Give us three numbers, before we wind this down. After sales service, well, that's the margin accretive business, right? So what do you end this year with? Also, pre-owned, you've had a good start to the year, pre-owned revenues. So what do you end? What do you end? The year with as well on both these two revenue aspects. And since premiumization is doing so well, last year I think the average sales per vehicle was around 17-18 lakhs, if I'm not mistaken. Where do you see that number headed to?
Can you repeat the last part? I missed that.
The last part, the average sales per, I think it was average sales per vehicle. The average selling price, I think it was 17.7, if I'm not mistaken. Where do you see that number headed?
It has gone up to 19.5 lakh rupees for the first quarter. That's something I can do with the Mercedes-Benz high-end vehicles being available. 25% of what happened, Santosh Iyer went ahead and said that are 1.5 crores plus. So this is something which we are hoping to maintain. We have got the average selling price for sales and service both up. Now the volume has to kick in. Now to answer your pre-owned car question, that is a third pillar of business that we are building. And in your last interaction, we had spoken about the unique business model that we are doing, which nobody else in India has done. And I believe that we will succeed in that. And we are looking at around 100 to 120 crores of revenue from this business, which will be like threefold from what we did last year. And we will grow higher in the years to come.
I had more questions, but out of time, Sanjay, so we'll request you to come back on. But thank you very much. So a great explanation, and hopefully Q2 will be much better, as you said, with all those launches which are lined up. Well, that's Landmark Cars. So we'll take a very quick commercial break here, and I think there's about 15 minutes to go for the pre-open session. Prakash is with us. Anuj will come in on the other side with a quick check on how he's looking at things. Our technical experts also lined up after that. Stay tuned. Welcome back. 13 minutes to go for the pre-open session. Anuj is here with a quick check on things, how he's looking at the trade setup. Anuj, morning.
Morning, Prashant. You know what? The market is quite interesting. It's testing patience, right? It's only fallen 2.8% at the Nifty level, but it feels like a lot because it's been almost 1 month of time correction that we have seen. Remember, we hit the high of 19,991 on 20th July. We're almost hitting 20th August, and the market's gone nowhere. The next level to watch is the 50-day moving average of 19,240. The problem is the bank nifty because it's fallen about 5%. And the trend started even after good numbers when the stocks stopped reacting to that. So I think that was something which clearly told you that there's a bit of an issue. On the index, the bank nifty itself, it's now possible that you hit the 200-day moving average. You test that at 42,750. The broader market has been fine till now. The advanced decline has been strong. The mid-cap index has outperformed. But let's see. As I said, the bigger problem is large stocks. The market lacks leadership. All the big stocks have fallen at least 5 to 7% or 8%. ICICI Bank, HDFC Bank and Reliance. Reliance, of course, I'm adjusting for JFS. Otherwise, it's fallen about 10%, but because 200 rupees is the value of JFS, so that's why we have to adjust for that, and it's fallen about 7%. As far as today's outlook is concerned, the market's texture is sell-on rally, and provided the rally comes in the first place. 19,350 is the first support, options base, and 19,240, the 50-day moving average, is the bigger support. On the upside, if there's a rally, my sense is 19,535 to 19,550. The 20-day moving average and Friday high would be it for it. 19,680 now is a long way away. On the bank nifty, its fin nifty is expiry today because tomorrow is holiday. And the last 4 expiries have been quite bad for fin nifty. So it's the weakest component. The only thing is that put call ratio is 0.61. So there's a bit of a hope. But, you know, as the movie Shawshank Redemption, he said that hope is a terrible thing. In market, hope is not a data point. The hope is that there's a short covering rally, but index is quite weak. Make no mistake about that.
Okay, all right. Thanks a lot for that. Anuj, you're looking good, today as well. Well, let's...
Likewise.
No, you're in the new avatar, Anuj. Had to chip that in. Okay, let's have a good day then. Let's move on. Manglam is joining us to tell us about the Adani Ports auditor resigns issue. Manglam?
Well, over the weekend, we got the news that Deloitte has decided to resign as the auditor of Adani Ports, and they said that they have concerns related to the company's wish not to independently look into. In fact, Adani Ports on its parts have accepted the resignation and at the same time approved the appointment of MSKA and Associates Chartered Accountants as the auditor itself. This morning, we got a note from CLSA. They said that they've had many auditor changes in the past, recently itself, and Deloitte qualified their FY23 accounts on related party transactions. And the replacement has been among the top 6 global audit firms itself. While this resignation may see a bit of a correction in the stock, they do continue to see this as a buying opportunity. They have a buy call with a target price of 878 rupees per share.
Thank you very much for that. Prakash Diwan is still with us. Prakash, your thoughts on Adani Ports? Whenever you have an auditor resignation, it's always viewed negatively. But here, as Manglam pointed out, it's being replaced by BDO, which is also a large, reputed, auditing firm. So does that provide you comfort?
So, Rima, there are 2 things. One is the explanation that comes from the outgoing audit firm is not very, very tenable in the sense, it seems a bit half-hearted. It seems too little, too late of sorts. And the second thing is, the company has already been kind of inspected or evaluated for whatever wrongdoings could possibly be there in the related party transaction or the group companies. And there's nothing which has been very culpable in that sense. So, of course, there's a SEBI report to the Supreme Court that also will be a big swing factor in this case. But my sense is the numbers that came some time back very clearly encourage you that it's in a very sweet spot on the fundamentals. So I don't see anything being challenged as far as earnings trajectory goes. And that finally supersedes all of these news flows. So my sense is the market might not react very negatively to this news.
Okay, got that. Prakash, stay with us. We'll just come back to you. We are kind of ticking down to the pre-open. Mitesh is with us, and so is Sudarshan with quick technical trading ideas and the setup as they see. Gentlemen, good morning. Great to have both of you here. Mitesh, let's just start with you first. The last time around, we saw a bit of a move down. We found support around that 19,300 kind of level, and then the market bounced. Do you think we'll get a repeat of that, or this time it's looking a little more tricky?
Morning, Prashant. I think that was just an intraday low and not a very key pivot point. So for me, it was not very important, honestly, even then. It was just a level from where the markets rebounded on a particular day. But what I've been looking at is one, I think 19,330 is the first support area for me, 330, 350 zones, and then 19,200, which was the gap which the market had done. That was a weekly gap, so very important level for me. So I think 19,200 is what I've been advocating will be the possibly, should be the worst case scenario to begin with. In case we start breaking below that, maybe we'll look at some more correction, but this still doesn't feel like a downtrend, still looks like a broader pullback of the entire rally, which started from 16,900. So 19,200 is the key area which I think I'll watch. Around those levels, we'll try to cover our shorts as well and even venture into long positions. So for the time being, I'm keeping the floating at 19,200, and on the upside, 19,650, 700 remains a very strong supply zone. My belief is that even on the medium-term basis, the markets might consolidate between this broader range of 19,200 to about 19,700.
Okay, all right. Thanks for that, Mitesh. Well, morning, Sudarshan. Give us your call on the index. The Nifty Bank in particular, that's a little bit of a worry one, right?
Yeah, good morning. See, the Nifty is now in some kind of a downtrend with very clear lower highs and lower lows. So that's a correction in every dictionary. So I do not think traders should trade corrections. They are very difficult to trade and quite tricky. So the trade for the Nifty is very easy and very simple. Do nothing. If at all you want to trade intraday, and remember it's only intraday, then you can wait for very sharp dips to take buy and then see what you can get out of it. But I would be surprised if you make anything at all. Wait patiently for the markets to stabilize. This is not stability. The Bank Nifty is a complete avoid. You don't even trade intraday.
Okay, you don't even trade intraday. Fair enough. Gentlemen, let's get to stocks. Sudarshan, what do you have?
I have BEL, which is a buying opportunity. The stock has been having a consistent uptrend. It's consolidating for the last 3 days, outperforming the Nifty. Consider buying it with a stop under 127. UPL keeps on coming in my short selling list because the stock keeps on falling down. Intraday short with a stop above 612. Ramco Cement broke down. It's now making lower lows, and then it's suggesting a very poor charting pattern, poor in the bullish sense. So it's an intraday short with a stop above 861. And finally, Polycabs had a big rally. That rally inevitably leads to a sideways move. It's now sideways. It's probably at a point where we can buy it, stop under 44.60.
Okay, all right, got that. Thanks a lot for that, Sudarshan. Mitesh, what about you?
Morning, Nigel. I have 2 buys and 2 sells. On the buying side is Hind Copper with a stop at 152. Recommend longs for targets of around 170. And Bharat Forge is a conditional buy. Buy above levels of 890 here. Keep a stop at about levels of 874 and look for targets of 1012. And on the selling side is HDFC Bank. Recommend selling here with a stop at 1635 for a first target of 1580. And Bajaj Auto, sell with a stop at 4650 and around 4500, 4485 should be the target area.
Okay, well, gentlemen, great to have both of you here as always. Thanks very much, and we'll speak with you soon again. We'll take a very quick commercial break here. There is 5 minutes to go for the pre-open, so we'll have that. We also will have Mr. P.R. Hari, Chairman and Managing Director at Garden Reach Shipbuilders, to understand the first quarter numbers and how things are progressing in Q2 as well. Stay tuned.
Welcome back. It's a Monday morning. We're kickstarting, today's trading session in just about 15 minutes from now. Before that, let's get a quick handle on what's happening across Asia. It's deeply in the red. The Hang Seng has a cut of more than 500 points now. It's down 2.7%. The Taiwanese index is down 1.5%. Go down lower, you've got Shanghai with a cut of 1.5%. The Japanese markets, that's the Nikkei index, is down close to about 1%. So Asia is firmly in the red. That's the GIFT Nifty, currently down 82 points. With the fall today, it would be lower for the third consecutive session now. But what's the F&O strategy? And I think, Nigel, because tomorrow is a holiday,
today's financial Nifty
the
services.
Fin Nifty weekly expiry would be today. Chandan Taparia, derivative and technical analyst at Motilal Oswal Financial Services, is with us on the show now. Chandan, morning. First, the index trade, and then if you could take us through your stock calls.
Good morning, Rima and Nigel. Thanks for having me. So we have seen some profit booking in the market. And if I look at the last structure of 10 days, the index is making lower top where resistance are gradually shifting lower. Just a couple of days back, it missed to hit the 20K marks, made high near to 19,999. And after that, resistances are gradually shifting lower. And now the immediate hurdle for Nifty index goes to 19,560 to 19,650 zone. Until we remains below the same, we believe that market could retest the recent lows and can drift to us 19,250 to 19,100 level. So the trend and setup for short term is turning lower, looking at the weakness of the global market and the structure of the most of the heavyweights counter. So some sort of negativity will be there. Some profit booking decline will be there because already we have seen good run up in last 4 months of more than 3,000 points. So till it remains below 19,560, 650 zone, we are looking for a decline towards 19,250 to 19,100. Looking at the Bank Nifty index, here structure is comparatively more negative than the Nifty index. Technically, it completed a bearish head and shoulder pattern, which indicates some weakness. It is holding well below 20-day MA and 50-day MA, which indicates some downside. So till it remains below 44,444, we believe Bank Nifty can drift towards 43,750 to 43,500 zone. Now looking at the stock wise, here I'll select mix of buy and sell both, looking at the market scenario. So on buy side, we have buy on BL. Selective defensive stocks can do well. So BL has recently taken a decline and recovered well with formation of high rise, high lows on the daily chart. On weekly structure, it is making high tops, high bottom. So expecting momentum to continue even after the market weakness. So recommending to buy with stop loss of 128. Stock can head towards 140 level. Second trading idea, that is buy on Jindal Steel. This stock is holding well given a consolidation breakout of last 10-12 days. Momentum is intact with some put writing activity. The stock is outperforming even after the market weakness. So this momentum could accelerate towards 730. One can buy with a stop loss of 684. While on weakness side, we look at the counter like Vedanta and Canfino.
Okay, all right. Thanks a lot for that, Chandan. Appreciate you joining in and giving us your thoughts on the index as well as individual trading picks. Well, let's get back to earnings then. Vivek joins us to cover some more earnings that we didn't cover in our top 10 segment. Vivek, take it away.
Well, absolutely. A lot of earnings that have come in post market hours on Friday, and quite a few names, also widely tracked. First on our list, Aurobindo, good set of numbers from the company, largely above what the consensus was anticipating. Revenues higher by 10%, coming in over the 6,850 crore mark, versus the expectations of just around 7% growth. Margins too have expanded quite significantly on a year-on-year basis. EBITDA margins coming in at 16.8% versus the estimate of 15.6%. Profitability coming in at 569 crore. This is up 9% on a year-on-year basis. The US sales figure too coming in quite strong. US Q1 sales has come in at $402 million versus an estimate in the range of $370 to $390 million. The other stock on our radar, JK Cement, one-offs have actually impacted the profitability this quarter. However, revenues higher by 21.6%, largely aided by volume growth of 27% on a year-on-year basis. EBITDA flat on a year-on-year basis at the 408 crore mark. Margins 14.8% versus 17.9% on a year-on-year basis. Profitability down 30% on a year-on-year basis. However, profitability was impacted due to higher finance costs, depreciation, and a one-time exceptional hit that the company has taken as well. Lastly, Sun TV, going with the red on this particular name, while revenues were above what it was estimated, largely also driven by the IPL one-off earnings that have come in. Revenues higher by 11%. EBITDA as well as profitability were both below our poll, and on the back of that taking a red, ad revenues too have dipped 1% on a year-on-year basis here.
Okay. Well, thanks very much, Vivek, for that. By the way, you got the currency, the rupee, which is opened. It's now crossed 83 to a dollar. So there is some weakness coming through in the rupee this morning. A sharp one, 0.25% lower. Last week was pretty weak as well. But that is not just the rupee, right? I mean, you look at the yuan, you look at the kiwi, you look at the Australian dollar. There is weakness everywhere, most currencies, and that is largely as a result of the dollar, which has been rising.
The dollar index has hit 103, by the way. I think in the morning or last night, it was closer to 103, almost there.
It was just under 103.
Just under 103, and now it's crossed it.
I mean, that's what they say, right? US exceptionalism. It has been exceptional. So growth is great. Inflation is starting to come off just about slowly. So that's the economy, which seems to be in still the best shape. So there you go. That's a dollar index as compared to, that's a basket. But of course, I mean, other individual currencies are feeling the heat on the other side. Prakash is still with us. Prakash, any thoughts on any of the earnings which Vivek put out?
No, so I think what stands out is that some of the cement names, while there's been a little bit of shrinkage in profitability or margins, have continued to show some very strong volume growth. So that's very positive for the sector as a whole. If you pick some winners in there who have much more efficient units, you'll probably get rewarded faster than the others. So, like the likes of Ambuja, smaller names like Orient, they could definitely, start contributing much more to the alpha generation. From the results that we discussed, and one of the things I wanted to point out was landmark cars. While we've heard the management say why the numbers were slightly softer and all, I think it's probably one of the best bets on premiumization that you could have in a segment with otherwise you don't get to participate, right? I mean, we've seen that happen in some other FMCG names and all of that with premiumization as well. But this is big ticket consumption, and some of the vectors that are working in their favor will probably give you a very good opportunity, especially if the stock opens soft on the back of these numbers. Of course, it's moved from the 500 plus neighborhood in a year's time quite a bit. So valuation is a little bit of a concern. But any softness in valuation, Prashant, would probably be a very ideal opportunity to enter into the stock.
Prakash, appreciate you always joining in and giving us your valuable inputs on a whole host of stocks. So wishing you a good day ahead and enjoy the holiday tomorrow as well. Well, let's get to our next management then. Garden Reach Shipbuildings, well, that's the one on our radar. It was a rather good quarter for the company, mind you. Their margins have expanded sequentially as well as on a year-on-year basis, and the other income has aided the profitability as well. We have Mr. P.R. Hari, the Chairman and Managing Director at the company, who joins us on the show. Hi, good morning, sir. Thanks so much for joining in. Well, give us a few numbers then. It's a good start, first of all, to the year. So tell us, what kind of an execution plan do you have this year? What could revenues look like by the end of this year? Margin outlook, as well as an update on what is the latest order book number.
Thank you, Nigel. As you said, the start of the year has been very encouraging. The Q1 results have been very positive, with our both revenue from operations and the profit after tax touching new heights. Actually, the best ever in the performance in the history of the company. 30% increase in revenue from operations and 54% increase in the profit after tax. Now, even as you rightly mentioned, even the margins have gone up. What we are very confident is that considering the present project execution phase, we will be able to maintain the tempo in the coming quarters too. That is our assessment with respect to the performance, financial performance in the current year. We are very confident of maintaining the tempo. We have got a good start. We intend maintaining the tempo. As far as the order book position is concerned, we stand at a very good 24,456 crores. This is our current order book. 4 projects for the Indian Navy comprising of 19 warships and 2 more projects, one for the government of Bangladesh and one for the government of West Bengal. This is our current order book position. And the naval order book comprises of 3 P-17 Alpha stealth frigates, and this is our big ticket item. And in this project, we have almost 13,745 crores remaining for execution.
Mr. Hari, just one quick question. I believe your 23 yards, they're fully utilized. So you're resorting to some subcontracting. Could you clarify on that point? And also, will that have an impact on margins?
Yes, as part of our business strategy, we have been resorting to a certain amount of subcontracting. That is a part construction of ships, and in some cases, certain blocks, hull blocks, have been subcontracted. And this is, as I mentioned, it's a part of a business strategy to utilize, one, the spare capacity of competent shipyards, and also to facilitate concurrent construction. To answer your question regarding margins, it has got zero effect on the margins.
Mr. Hari, hi, good morning. Prashant this side. Could you tell us what is the order inflow going to look like? Are you expecting any large orders at the end of March? Your order book was 25,000 crores. You said it's about 24,500 now. What should we expect, sir, in the remaining 3 quarters?
Thank you, Prashant. During this quarter, while we have executed, as you have seen, around 750 crores, we also got a 250 crore order from the Indian Navy for manufacture of 30 naval standard guns. So this is what has added and stabilized our order book. Now, we are expecting from the Indian Coast Guard, we already submitted our bids. 3 projects, the bid is, the L1 is likely to be declared in a couple of months. So this total value comes to almost 4,000 crores. In addition to this, Navy is likely to come up with RFPs for 2 in number multipurpose vessels and also 5 next generation survey vessels. Of course, both these projects, it is unlikely that the orders will fructify in the current financial year, but we are very confident that all the 3 Coast Guard projects, the orders will fructify, and we stand a very good chance of winning these orders. So our overall target would be to maintain plus 24,000 crores at the end of the current financial year.
Okay. Mr. Hari, very quickly, post Q4, in your conference call, you said, we expect to touch the peak revenue generation during the coming 3 years, FY24, 25, 26. Now, there are some concerns that your order book will exhaust by FY27. Can you talk about, in this current order book of, 24,500 crore, how much of it will be exhausted in 24, 25, 26? And what about thereafter in the, RFQs that you have?
Thank you, Rima. Now, yes, I had mentioned that the peak revenue generating years will be FY 24, 25, and 26. Bang on, and we are right on the target. As you can, it is very evident that in FY 23, our revenue from operations were 2561. In the first quarter, Q1 of 24, we already touched 756 crores. We expect the peak revenue in 24-25. Now, coming to the order execution plan, we have right now around 24,500 crores, and we expect to deliver 2 P-17 Alpha. They are our biggest revenue earners during FY 25 and FY 26. There, the order book value remaining is around 13,500 odd crores. As this order book depletes, as I had mentioned, more orders are on the anvil. See, Coast Guard and Navy, both these forces put together, there is almost, I'm not telling in this financial year, but over the next 3 financial years, almost 1 lakh plus crores order book on the anvil. And there are about 6 shipyards which are the serious competitors are around 6 shipyards. 4 of us, that is 4 defense shipyards, plus Cochin shipyard, plus L&T. So there is enough on the plate for all of us to grab. So we see as this order book gets executed and depletes, more orders will come in. So we'll be able to maintain the tempo of revenue from operations definitely for the next 3 years and beyond. That is our confidence level.
Okay. Mr. Hari, unfortunately, we're out of time. Thank you very much for joining in, and wish you a happy Independence Day. Let's get to Sudarshan and get in the 910 call. Sudarshan?
BEL is a buying opportunity with a stop under 127.
Mitesh, what about you?
I'll go with a sell on Bajaj Auto with a stop at 46.51 for targets of 4,500.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's run you through a quick couple of stocks that will be in focus. JSPL, the numbers look good, EBITDA as well as margins. Brokerages, well, Citi, they have a buy rating. The target price they've raised to around 810 rupees. They like the fact that, the companies could be a play on China recovery. The net debt to EBITDA as well at sub 1, they like that as well. Kotak Institutional, where they go ahead and they've increased the target price to 815. They say they've received approvals for 2 of the 4 thermal coal mines, which will reduce costs, which is a big trigger out there. And also, they like the fact that the company is on course to go to 15 million tons in the next couple of years. CLSA, though, they're downgraded to underperform, target price of around 720 rupees. They say that spot prices have corrected a little bit. That could pressurize margins. And also, there's a delay in expansion, so they don't like that too much. And MS, they have an underweight rating with a target price of around 460 rupees odd. Well, let's get in another stock as well. Surabhi joins us to tell us about Voltas. Surabhi?
Thanks so much for that. It's a completely mixed bag for Voltas. The revenues were above expectations, but the margins were below expectations. Brokerages also have a split view on the stock. They say despite a volume growth of 15% in the AC, market share was down, which they find surprising. Voltas continues to see AC market share extremely competitive and guides for single-digit margins. They believe the unitary cooling product segment outlook, competitive intensity and inventory position over there will be something to watch out for in the coming quarters. And also management's commentary inspires very little confidence on immediate recovery in the UCP or the EMP segment. That's what they say. CLSA and Jefferies have a buy rating. They have a target price of 1,000 and 950. Kotak has a sell rating with a target price of 750, and Morgan Stanley has an underweight rating with a target price of 735.
Okay, thank you very much for that. Just a few seconds left before we open for trade. Currently, the Nifty is going to open below the 19,400 mark, a cut of close to about 45 to 50 points. The stocks you should keep on your radar, ONGC numbers look good. In pre-opening, it's suggesting a positive start. That's currently up 1.5%. And you've got Adani Ports. Post the resignation of Deloitte as their auditor, Adani Ports could be one of the big drags today. That's in pre-open, it's down 2.5%. The bell goes and the Nifty opens at 19,380, a cut of nearly 50 points straight away, down 0.3% on both the Nifty and on the sensex. The mid-cap index is taking a bigger cut today, with the mid-cap index down nearly 0.5%. Banks continue to come under pressure. The Nifty banking index is down close to about 0.4%, 180 points lower, with heavies like HDFC Bank, ICICI Bank under pressure, exerting pressure there with a cut of close to about 0.4%. Let's take you through some of the big movers, at least at the index level. Adani Ports is the top Nifty loser, 3.1% gone on that. And the other Adani Group company in the index, at least, Adani Enterprises, is also lower by close to about 4%. So those are the top two losers. Apart from that, you've got weakness in auto names like Eicher Motors and Tata Motors. Hindalco is weak in trade, and that's lost nearly 1.7%. IT is broadly lower. HCL Tech, TCS are currently trading with cuts of more than 0.5%. The gainers list is quite sparse. Only, I think, 4 or 5 stocks currently are making it, with some green on the screen. ONGC is the top gainer. It's a fresh 52-week high on that. As the numbers look better than what the street was anticipating, good margin performance, and the stock straight away opens with a cut of about 1.5%. ITC ahead of numbers is absolutely flat, while Divi's Laboratory is down 1.2%. Again, we are awaiting numbers from Divi's today.
Well, we move to the low point of the day, Rima, on the Nifty itself, almost at around 19,300, so keep an eye out on that front. A few gainers, though, very, very few gainers. Genius Spark continues its up move. It's up closer around 4%. Positive commentary on the con call. You had Amara Raja, that's up closer to 2.5%, so positive reaction is what we're getting in there. Box office hits over the weekend. Gadar 2, very, very good, I believe. So we have PVR Inox that's up close to 1.5%. On the flip side, many stocks are taking it on the chin. Your Vipka Laboratory is down close to around 6%. City Union Bank is down close to around 5%. Muthoot Finance down another 5%. Nalco, the numbers were weak. That's down close to around 3%. And JSPL, we said the numbers were good. The only problem with the numbers was the street seems to have sensed that. And there was pre-buying on Friday's trading session. The stock ended at the high point of the day. And that one is coming for profit taking down close to around 2.5% or thereabouts. India Cements as well down close to around 3%. Big volumes in early trade. Voltas, well, that's pulled back close to around 2% as well. Yes, market share gains come about, but still those numbers are a little lower than what the street was working with. Prashant, what else?
Well, it's a full 100-point cut now. So, 19,310 is where we are at on the Nifty. And maybe just take a quick look at the other indices as well as we start. The Nifty Bank should come up. That's down about 0.6%. So that's falling in line with what the Nifty is doing. Mid-cap index will come up on your screen. That's down a full 1%. And the small-cap index is the last one, which is down about 1% as well. So across the board, there is pressure, which is emerging. Just a few more names. Look at Astral. I was highlighting that earlier. I think there's a CLSA downgrade. Numbers, by the way, are not bad. Numbers are in line for the first quarter. Stocks down about 3%. So keep an eye out on that one. Info Edge, I think we highlighted that. That is down this morning with 3.5% cut the last I checked. Muthoot is a sharp cut, right? I mean, numbers, again, I think the problem is spreads. And we'll talk more about that one. But the stock from 1,000 rupees, where it was languishing, had come up nicely. Patanjali is the other one, which is down about 4% or so. with a steep cut this morning. IRFC, I think we highlighted. IRFC, but they've got the largest volumes this morning. Huge in terms of volumes. It's down 4% as well. So that's the losers list with at least what's got volumes in it. Genus is racing ahead. Full 7% pop. You know, for the longest time, after they announced that deal with the GIC, stock kind of was stuck at that 190 odd rupee levels, but that's taken it out, and we're running up on this one. So that is Genus for you, doing well. And there is Cochin Shipyard, which is up 3.25%. Garden Reach was with us. The management was with us 15 minutes back. That is up about 4%. So reacting to earnings and a decent commentary. And there is something like a rate gain, which continues its up move. Rate gain numbers were super solid, and that's kindly sidestepped any correction that the broader market has seen over the last couple of days. Look at KDDL, right? That's the Kamla Dials. Ethos was having a very strong move towards the end of last week, and Ethos numbers were strong. KDDL this morning is up 12%. 2,065, it should come up on your screens. And it's got decent sized volumes for this point of the day. That's KDDL. We'll try and have that up for you in a bit.
Nykaa. Let's just quickly pull up Nykaa. It's down 10% right now. Numbers were pretty okay. The BPC segment, the beauty segment, has done well, but the fashion segment hasn't performed as per the market expectations and even the company expectations on account of competition. Remember, there's also been the launch of a competitor platform by a competitor with deep pockets, and that's also hurt. And Nykaa has gotten hit quite hard. And another one, NetWeb Technologies. It's the first results for the company post-listing, and it had seen bumper listing, very strong subscription, but the stock is down 5.5% in trade. The numbers are weak. Both quarter-on-quarter, year-on-year revenues have declined.
No, absolutely. So here's some very sharp moves coming through. I was referring to KDDL. I mean, I don't know if you can pull the stock up. It should come up on your screen. So that's a decent mover, 12% higher on decent volumes. Vetri Subramaniam is with us, Chief Investment Officer at UTI AMC. Vetri, great to have you with us here. Good morning. Thanks for your time. How are we looking in the near term? And then, I mean, beyond that, do you think we are at the cusp of a bit of a sell-off in what has been a pretty good bull market and perhaps remains so?
Morning, Prashant. Good to be here. I don't have much of a view on that, Prashant. Don't really trade the market looking at such short-term moves. We are sort of focused more on the longer-term moves in the market and construct portfolios based on that. We tell our investors to think long-term, and that's exactly how we tend to behave ourselves. So we don't try and chase the market in terms of short-term moves over weeks or days.
That's perfectly fine. But do you have a view, Vetri? I mean, in terms of broadly, is it a time to sort of dip in aggressively? Is it time to pare back? Just a broad kind of view.
Sure. No. Yeah, let me sort of fill you in on that. So, internally we do run some asset allocation models which feed into our advantage and multi-asset strategies. And this is really a composite of valuations that we are looking at to determine how attractive equities look at every point of time. And that sort of stuck, I would say, somewhere between neutral to expensive. So to put it in perspective, Prashant, if we find equities really unattractive, the model can drop allocation all the way down to 30%. And if we find valuations hugely attractive, it can raise the allocation all the way up to 90%. It's pretty much stuck right in the middle right now at about 60%. And, when I look at particularly the mid and small cap segments of the market, there's some element of them actually being slightly richer than even the Nifty, which is the primary model that we look at. So I would say, this is a time to sort of manage your risk, stagger your investments. And if you're choosing to make large investments in the market, then, you're sort of in that neutral zone as far as valuations are concerned.
Vetri, morning. What's the best way to manage your risks? You said that the valuations in small caps is slightly on the higher side. Would you reduce your allocation to small caps? Which would be the themes that you would bet on where you're still comfortable with the risk reward?
Sure. I think from a market cap point of view, Rima, we'd be most comfortable with the large caps, followed by the mid caps, and least comfortable with the small caps. Having said that, I should say that this was my view even 3 months ago, and I'm surprised by the strength that we've seen in small caps during this period. But to my mind, not just the valuations, but also looking at the macro environment where, rates look like they're going to be higher for longer in India. Certainly that's the case globally. Global growth, certainly the US proving to be quite resilient, but it's not like global growth is gangbusters, so we haven't really got positive sort of tailwinds kicking in from there. It's not a great macroeconomic environment from my point of view for the mid and small cap parts of the market. So large caps is where we have the maximum comfort. I think from our point of view, one of the more contrarian calls we had was more sector rather than market cap, which is the pharmaceutical space. Again, that's been something that I liked even in 22. It didn't do much, but in this year, finally, it's sort of starting to show some good performance, and that would continue to be an area or a sector that we would back with sort of valuations in favor, and I think still sort of contrarian positioning over there.
Hi Vetri, good morning. Well, as we speak, the Nifty is at its lowest levels we have seen since I think the 4th of July. So a bit of selling is what we are seeing creeping in there. Well, Vetri, you get the point. US economy is actually looking solid, more solid than what most were expecting, and you're sounding a little bit cautious on the broader markets. But a couple of aspects, Timken India, they have put it on the exchanges that demand is a little bit slower. And after a while, we're hearing things like this. Will you be, do you think the Indian economy as well in the near could be in for some softness? Premiumization, yes, that's picking up, but there are pockets which are still in pain. Your view on it?
No, certainly, Nigel. I think, I'm sure, and I don't want to go back to the K-shaped recovery. That's certainly been something which is visible when we look at the data of companies. There's a big divergence in terms of the kind of income class to which companies are selling their products. Those selling to upper and higher income categories have actually done far better than those selling to the lower end. I think as far as growth is concerned, I would just say that, look, we've come out of this pandemic period in really good shape relative to other parts of the world, but it puts us on trajectory for maybe 6% GDP growth, give and take a little bit here based on how global tailwinds and headwinds sort of pan out. It's not like growth is like off to the races. And I think when you look at the commentary that's coming out of the MPC, which is essentially saying that, we are concerned about inflation. We don't really see any rate cuts on the horizon. We are going to continue to persist with, withdrawal of accommodation. You get a sense that, we are in a reasonably good place, but not like we are off to the races. So that to my mind is a little bit of a challenge when you talk about, having very elevated growth expectations. And I think the other factor, which perhaps in global markets, we will need to sort of pay some attention to is while the US has certainly surprised in terms of the strength of the economy, China is proving to be a particularly significant pain point at this point, not just in terms of growth, but also in terms of the fact that it's now starting to export deflation. Not a bad thing given that everybody is concerned about inflation, but it has longer term ramifications.
Yeah, no, absolutely. I put out a piece on Friday on China, and with a slightly longer term, it's kind of headed Japan's way from 30 years ago when we had a very prolonged kind of downturn. But that's, one for the long term. Vetri, so you said large cap orientation, right? So what happens is one gets to get carried away and kind of, because the most money has been made in small caps. So I'm assuming that, and we've not had this downturn for a while. It's just 140 points right now, but we've not even had that. The small cap index is down 1.5%. And I think you can count the number of days the small cap index has been down more than 1% since the rally started from late March. So if for those who are heavily into this part of the market and are watching this, the natural impulse which kicks in, well, it'll be okay. So you think they should actively kind of look at moving investments into large caps, that kind of thing? Your advice?
Sure. Again, I can't give a one-size-fits-all prescription to everybody out there. But from a valuation standpoint, I do think the small caps give me the least comfort. I also think, Prashant, we've got to be a little bit careful, when we look at year-to-date data, or even if you look at 3-year data, you're picking up a very favorable base point in terms of the returns from small caps. If I just shift the horizon to, let's say, 5 years or 7 years, things will suddenly start to look very different. In our sort of modeling, when we look at the data on a rolling basis over much longer time periods, actually the most attractive segment of the market over the mid to longer term tends to be the mid caps, which not only gives you better returns than large caps, but is also superior on a risk adjusted basis. Actually, this is not true of small caps. Now, there could be some individual small cap funds which do well, but when you look at the small cap index, its risk adjusted returns are actually not very great. So to my mind, that will continue to be a little bit of a cautionary note as far as small caps are concerned. And historical experience, been in the market for 30 years now, every time you see the economy go through a little bit of pain, the companies which are most vulnerable to that tend to be the mid caps, tend to be the small caps. So that's where I would sort of raise that flag of caution. I don't know individual people's allocations number, but certainly given the valuations, I would take some money off small caps and move it to large caps.
Always good hearing your thoughts, Vetri. Thanks so much for stopping by and filling us in with your commentary. So not a bad idea, I think, to be a little bit cautious and maybe finding more comfort in large caps in comparison to the smaller cap names. Well, let's move on then. Astral, that's a stock on our radar for Q1. Their revenue has come in line, but margins have contracted a little bit. Realizations as well a little bit lower. The EBITDA also missed expectations. Well, to understand what's the way ahead, we're joined with Mr. Savlani, the Executive Director and Chief Financial Officer at the company. Hi, Mr. Savlani. Good morning. Thanks so much for joining in. Well, let's focus on your pipes business first. For the first quarter, I think the value was much lower than volume growth due to reduction in PVC prices, obviously. So tell us, what is the volume growth we should be looking at for this year? That's for FY24. I think earlier you were guiding for mid-teens. And also it appears that your growth in the first quarter was a little bit slower than, say, Supreme Industries. What is your market share?
So first quarter, the volume growth was 31%, which was a very, very robust. Secondly, we should also understand that the Astral is predominantly a plumbing company. The sizable volume which is coming in the market to the other competitor, that is mainly from the agricultural business, where the Astral presence is very, very low. So that is the reason compared to other you feel that is otherwise in a plumbing side, I think we are perhaps the having highest volume right now in the industry. So volumes were very, very healthy. And you rightly said that the top line was low because of the polymer effect. Now the polymer have started inching up. So in the coming quarter, you will see slowly and gradually the value growth will come back. Margins were also very, very decent, I can say. If you compare with any of our peers, we were the highest in the industry. So margin front also, we are very, very happy with the performance. And in the coming time also, the way volume have started coming back, we are seeing that in the coming quarter, volume can be very, very robust because the way the year has started and the way this current quarter also, first almost 40 days, we have crossed 40, 45 days. The numbers are moving in the same direction what we have seen in the Q1. So I think we are very, very excited with the performance of the company.
Thanks, Mr. Savlani, for giving us that clarification, because in your core business, you're not losing market share. In fact, you're seeing the volume growth is as much. So we get that. But for the year, what kind of a volume growth are you targeting? You stick to mid-teens, or since Q1 has been good, the first 40 days of Q2 has been fairly good, you want to revise that number upwards? What should the range be, volume growth?
So I think we have given the guidance of 15% on a full year basis, but the way numbers are moving for the first, I think, quarter and the first 45 days of current, I think it should be much, much higher. But keep finger crossed. Once we will be completing Q2, we will be revising upward our guidance.
So Q2 so far, Mr. Savlani, has been running at 30%? Same run rate?
Yes, 30% plus.
Okay, so it'll be, and you said at the end of Q2, you will revise your guidance upwards.
Yes, yes.
Okay. Should be at least a 5 percentage point increase, right? If not more.
Let me complete the Q2. I think it will be a surprise to the market.
Okay. Mr. Savlani, could you talk to us a little bit about margins and how they are likely to pan out? What's the guidance there?
I think margin we already given 16 to 18% zone, and we are on the upper end right now. So I don't see any problem. In spite of lower polymer price was there, we have maintained our margin. So coming time when our main seasonal business quarters will start from October onward, I think there the contribution of value-added product is always high. If you see the history of last 10, 15 years, contribution from our main core product CPVC and the value added product is always high. You see the Q4 number also, our margins were 20% plus. So I think in the coming time, we are seeing that once the value added product contribution will start in the coming quarter, margin can even improve from here.
What's the contribution of the value added products? And by when do you expect it to significantly scale up? And what would be the long-term margins? Currently, for this year, 16 to 18% is your margin guidance. But can you just stretch the horizon a bit and tell us what would your aspiration be?
So like we have given the long-term guidance only 16 to 18% because the polymer is always highly volatile. So in that environment, giving a higher guidance, it is always a painful. So we don't want to unnecessarily create a grapevine in the market or unnecessarily misguide any of the investors. That's why we are always conservatively giving guidance. But yes, definitely we will try our best. If you see the history of last 3-4 years, we are always on the higher end. So we will try our best to fetch higher margin. But this will be the broader range. That is what we have given the guidance.
Okay. All right. Well, Mr. Savlani, by your own admission, selling of bathware as well as faucetware is a little tougher, right, than selling pipes. How do you see the sanitary ware as well as faucet business shaping up? What could the revenue potential be? For this year, what is the target? And going ahead, how do you see this business scaling up?
So any new vertical is always tough. It's nothing easy in the business. So definitely it is a tough. But I think the way brand is there, the way Astral brand is strong in the market, we are quite confident that this segment will also give us a good number. I think in the very first year, we have still not completed 1 year. We have crossed the 5 crore run rate for the last 3 months. So I think it is shaping up very well. We have created more than 500 showrooms plus touch point in India, and another few are in the pipeline. So I think we are going in the right direction. We don't want to unnecessarily jump in a fast volume growth, and then there is the problem. So we are going very, very steadily, and after understanding the market, we are moving in the right direction. So I think once the project business will start coming to the system, I think volume will shoot up there also. I think it will take another 12 months time to pick up the volume, but we are confident that slowly and gradually we will take this business also to the new scale.
So currently you're doing 15 crores per quarter, right, in terms of revenues?
Yeah. Yes.
And so say in the next few quarters, how do you see this number scaling up on a quarterly run rate? What should it look like?
So I think every quarter, next 6-7 quarter, every quarter you will see there will be improvement.
Mr. Savlani, I think you said this business, the new business will contribute 1,500 crores in the medium term. I think that's the number that you put out?
Yeah, for 5 years, next 5 years.
Over the next 5 years. Okay, and much higher margin business here, right?
So initially not, because initially the scale will not be there.
Of course.
So margin will not be that equivalent to our current business. But once they will reach at a certain scale, then definitely it will be contributing higher margin.
All right.
Just one final question. So you've incurred an inventory loss in the current quarter of, I think, 15-17 crore. Thereabout. Is this something which will persist?
I don't think so. It will be there because now the polymer prices have started going up. If it will further go up, it can be inventory gain also in the coming quarter.
Okay. All right. Mr. Savlani, you have a capex, I think, of around 350 crores for this year. For next year as well, you have around 250 crores. And you have expansions, in various units, whether it's Guwahati, Hyderabad, Kanpur as well. I think your current capacity is around 290,000 odd. Given by, going by what you're doing in your core business as well as the diversification, the sanitary ware as well as faucet business, where do you see your revenue potential, the peak potential? Give us a 3-year time horizon. How do you see this ramping up? As of last year, your revenues were around 5,200 crores ballpark with 18 to 16% margins on. So how do you see the revenue scale up? In 3 years, where should it be?
So I think we have given a guidance for next 5 years for 15% CAGR, and we are standby with that guidance. But the way demand is shooting up in the piping sector, I think I'm very, very excited. And that is the reason you see in the history, Astral has never ever done an announcement of 3 plants at a time. So this is the first time that we are putting up 3 plants at a time. And that is what showing the confidence of the management. The coming time, we are expecting the 5 business to do really good for our organization. And the number can be upward direction also. But because once this plant will be commissioned, then only we will be capturing the new geographies, and then we will be taking the market share in that particular geography. So keep finger crossed. Once this expansion activity will get over, we are very, very excited right now to come as early as possible, because we have already allocated the sizable, I think, money to our other businesses. So now new capital is not going to be contributed to our other businesses. Maximum contribution will go to the pipe. There we are seeing a very, very robust demand, and we are continuously getting the market share, which you can see for last 3-4 years number. And we are very confident that in coming time also we will gain further market share in next 2 to 3 years time.
So we're going at 15% CAGR, say in the next 5 years. I mean, say by 2027, 28, revenue should be at 10,500 crores approximately, just going by that calculation?
Hypothetically, 15% CAGR means every 5 years you are doubling your revenue. So naturally 10,000 crores.
And you don't have to put any more capex for that?
I think normal capex will be there, will not be a substantially high capex, and we company sitting with sizable cash, so that is not a problem to the organization. We are a debt-free company.
Got it.
Thank you, Mr. Savlani, for joining in. Wish you all the very best. Let's move on. Apollo Hospitals has reported a mixed set of Q1 numbers. Revenues and margins have come in line with street expectations. In the conference call, the management has said that lower discounts has impacted the top line in their 24/7 business. Sunita Reddy, the managing director at Apollo Hospitals, is now with us on the show. Ms. Reddy, morning, and thank you very much for joining in. Let me get to your omni-channel arm, Apollo 24/7. On a quarter-on-quarter basis, I believe the losses have come down. Can you give us some guidance on reducing the cash burn? When will you, achieve operational break-even? And by how much have the discounts come down by?
So if you look at, the company has grown very well. Apollo Healthco has registered 1,805 crores of revenue, which is a growth of 22%. However, the losses were at 83 crores, which is down from last year when it was 89 crores. Going forward, yes, the company has reduced discounts. Discounts have come down from 18 to 15%, and this has resulted in a lower cash burn. Being an omni-channel play, the offline has done extremely well. They have grown by 22%, and this has really contributed to cash flows. Going forward, I think the company is well poised to reach a EBITDA break-even in Q4 and achieve 3,000 crores of GMV.
Hi, good morning.
Morning.
Could you tell us how much have online discounts reduced in the pharmacy space, and what's been the implication for growth there, revenues?
I think the best way to do this is to deconstruct the revenues. So offline and the offline EBITDA came in at 125 crores, which is really a growth of 13%. And there was a cash loss on online of 57 crores, which resulted in a negative 83 crores. So discounting, as like I said earlier, has come down from 18 to 15%. And there was also cost rationalization and focus on profitability that has yielded this quarter's set of numbers. But they are on track to achieve 3,000 crores of GMV.
I remember you had said that last quarter as well, that the omni-channel business will achieve operational break-even in Q4 of FY24, and you're sticking by it, Ms. Reddy. Just one more, question on this, subject, and then we'll move on to the other businesses, hospitals. You had fundraising plans. You were looking to raise, money for the omni-channel play. Could you give us an update on that?
So currently, we are in a very healthy state with the offline generating enough cash for the business. However, like I said earlier, we have opportunities to raise capital but this should not be at a discount to the actual value, and this should really maximize shareholder value. So we will look at this opportunity in September again, but currently the company is very well funded for growth and to achieve its targets.
All right. Hi, good morning, Ms. Reddy. Well, give us a couple of more numbers then. How do you see occupancy shape up from here on? And also your average revenue per hospital bed, if you could tell us, how is that number as well moving?
So we were at 62% occupancy. Going forward, we are on track to reach 68% by the end of the year. What is improving is our payer mix. So if you look at 82% of our payer mix now comes from insurance and cash. This has grown by a healthy 11%, and this has contributed to a volume growth of 6%. Currently, international patients are at 6% of total revenue, and this has grown by 34% over last year. So going forward, we are looking at a healthy occupancy of 68% with this payer mix. And this is what has contributed to our ARPOB is clearly the fact that, our centers of excellence, our Congo specialties have contributed to 63% of our revenue, and therefore with the higher intensity of case mix and this payer mix, our ARPOB has gone to 57,704.
Ma'am, could you talk to us a little bit about margins, because they're blended margins overall. So cost pressures seem to have emerged across segments. I mean, hospitals, Apollo Health and Lifestyle. Could you guide us on what blended margins could look like going ahead, FY24?
So I think, the healthcare services business has registered good margins, and there is a scope to improve these margins by 100 basis points. Currently, we're at 23.6, and we're looking at, ending the year with close to 25. Apollo Health and Lifestyle has added a diagnostic network, which has contributed to cost, and therefore, but they are registering revenues of 100 crores per quarter, and in line with our projections for 500 crores for the year. This is the network addition cost, plus we had some one-time cost this year of Apollo Health and Lifestyle had a one-time cost of 15 crores, which is why it looked like the costs have increased. In the healthcare space, yes, we did have additional costs. Bringing on doctors at guarantee money and employee cost has increased, but we do believe that, by the end of the year, costs will come down.
And for the diagnostic business, you're saying your guidance is for 500 crores of revenues for this year, versus about 100 that you've done in the current quarter. Can you just getting back? Yes. Can you just getting back to the hospitals business? You told us the occupancy target, I think 68%. The average revenue per occupied bed, as you pointed out, is 57,500 plus or minus. It's gone up by 11% on a year-on-year basis. What led to that? And what is the guidance on the average revenue per bed? I remember in some interaction before you had even spoken about 60,000.
Yes, clearly there is an opportunity to grow to 60,000. I think I answered that earlier when I said that our payer mix had changed with insurance and cash coming in at over 82% and international patients at 6%. And therefore, this has resulted in a higher ARPOB. This in line with surgical volumes going up by 60, currently at 63% of total revenue, has contributed to this ARPOB of 57,700 rupees. Going forward, I think, with this focus, we should be able to continuously, next year, probably grow the ARPOB by another 6%. But volume growth is where our focus is.
All right, Ms. Reddy, thanks so much for stopping by and filling us in with all those details. Wishing you all the best for the remainder of this fiscal, and we're looking forward to chatting up with you rather soon. For the time being, though, we'll slip into a short break. On the other side, we'll connect with the management of Vinity Organics to discuss their past quarter's numbers and the outlook as well. Stay with us. Welcome back. You're tuned in to Bazaar Morning Call here on CNBC-TV18. Well, Vinati Organics, they came out with their set of numbers. And more than the past quarter, I think the street wants to understand what's the way ahead on the demand front. To help us out with that, we're joined by Viniti Saraf-Mudrija, the Managing Director at Vinati Organics. Hi, Vinati. Morning. Thanks so much for joining in. Well, there was some bit of weakness that we saw in the past quarter. Can you explain what's happening across segments? Well, you get most of your revenues, as we understand, from the exports markets. So what's the demand situation like first up? And has quarter two started off on a better note? Is it looking better than quarter one?
Sure. Good morning. Globally, most chemical companies have announced a soft year going ahead. And 60-70% of our sales are dependent on exports coming from North America and Western Europe. And we are seeing a slowdown in those geographies starting, I would say, March onwards. In fact, we were well aware in March itself that for the next 6 months, most of our major customers would be destocking high inventory levels. Actually, what had happened last year, if you see in Q3 and Q4, most customers had purchased too much product, in fact, more than we had anticipated. And hence, the second half of last year was very good. But in the beginning of this year, they realized they're sitting on too much inventory. Maybe they were scared because of COVID and high freight costs, which has all come down and everything is normalized. Q2 looks, it will be similar to Q1. This destocking will continue up to September, October. I expect recovery in most of our product segments starting October onwards.
Amongst your three segments, which one has seen the most pressure? Could you just provide a little more color on that?
Yeah, absolutely. ATBS was the highest performer last year, especially in second half. And that is, in fact, seeing the biggest degrowth also and the biggest destocking effect in the last 4 months and also going ahead for the next 2 months. IBB remains stable business. So do our other niche products. Butyl phenols, in fact, we're seeing a slight growth starting now. We are able to penetrate better into the market.
Vinati, hi, good morning. One is destocking because people bought too much. And you say that'll continue, perhaps will normalize only by October. What about pricing? Vinati, if you can talk to us a little bit about that. How is that likely to pan out, next 2 quarters?
Actually, incidentally for us, pricing hasn't had a big impact. I know most raw materials are falling, but for us, while some have fallen, some have also remained same, such as MTB, which is our biggest raw material from which we make IB. So prices have remained more or less stable. It's the volume that has dropped. I see similar trends in Q2. Butyl phenols, there's some softening in pricing, but not in other segments like IBB, etc.
All right, Vinati, when do you expect the merger of Viral and Vinati to be done by? If you could give us a broad timeline out there. And also at peak, butyl phenol will contribute, I think, around 700 crores, right? When does it start showing up in your books?
Sure. I think for the merger, we should ask that question to NCLT. We've gotten the shareholders' approval, the lenders' approval. It's just been pending for the last approval from NCLT. It's really up to the courts when they take up our hearing. What was your next question on butyl phenols?
Butyl phenols.
Yeah, this year we will do about 200 to 300 crores in revenue. Full potential is about 400 to 500 crores, yes.
I think last time you had indicated that FY24 revenues will be flattish. Considering in Q1 the top line has degrown, Q2 is also going to be weak. What can you guide for the full year now?
Sure. I think the revenues still, I would maintain, we can maintain last year's revenues given 2 things. The degrowth in ATBS will be compensated by the growth in butyl phenols, as well as if the merger goes through, which I hope it should in the next quarter at least, then we will see about 150 to 200 crores revenues coming from antioxidants. So given all that, we expect to maintain about 2,000 crores in revenues this year as well.
All right, Vinati, since things are quite uncertain, have you revised your capex plans or are you sticking to what you had laid out earlier?
Capex remains as it is because that's a long-term view. Our long-term view still remains positive. In fact, even as far as ATBS is concerned, we are going ahead with the new line, which is expected to come on stream next year by March, April. The new products that we are getting into the anisole derivatives, MEHQ, that's on track as well. Wakefall, also isoamylene derivatives, so no change in Capex.
Capex earlier was what, 580 crores, right? And 240 has been spent.
Sorry, please repeat that.
The total Capex, Vinati, for the year, I think that was drawn out was approximately 600 crores, 580, 600 crores?
That's right. That's spread over 18 months, but about 40% of that has been spent. The most of the expenditure happens towards the end of the capex cycle.
Vinati, sorry, just one last question from my side. Slightly macro-ish. I mean, I don't know if that has implications. We got numbers. We're getting very pretty dire economic numbers out of China over the last 2 weeks or so. All outright deflationary kind of situation, at least for now. If that were to continue, I mean, what does it mean for raw material prices generally? You said things are steady for now because it got balanced. Some fell, some did not fall, etc. But do you think it's going to be a big factor over the next for the foreseeable future?
See, generally now what I have heard is because of China dumping, a lot of prices are falling. We do see that in some segments, China economy itself hasn't recovered, as the demand in China is slow. So they are dumping across geographies. I'm really not an expert because the China effect has less effect on our business as such. Because we compete less with them, and also we are in niche products where we have contracts in place.
Okay, all right. So that's why the Vinati Organic stock is also treated differently. I mean, you're up on the specialty curve, and
the margins we have more or less been able to maintain. If you compare the margins year on year, they haven't changed significantly.
Yeah, absolutely. All right, we'll leave it there. Vinati, great to speak with you. Appreciate you joining in. And thanks very much for taking the time speaking with us here on CNBC-TV18. Well, let's take okay, Mitesh and Sudarshan are back with us for a quick run on things. Mitesh is with us, actually. We're down 100 points. There is some recovery from the day's low which has come in. Mitesh, how would you look at things and what would you want to put out as a new trade?
Prashant, first a word on the index. 19,200 is what I was highlighting as the support area. Kind of, nearly being there, 19,257 being the low. I think around these levels, you will see some, positive traction come, some demand happen, and some short covering could happen. But a lot of stocks with this movement are breaking down. So I think, we actually, while on the index, I would advocate taking some profits on the short positions. On the stock side, is still looking at stocks, which could possibly give a correction or a pullback. So on the list is Ultratech Cement. I think today it made a low of 80.50. If it breaks 80.45, go short here with the stop at 8100. And a target of around 7900 can be looked at. And on the long side is Trent. After the numbers, the stock had bounced back very nicely. And then on Friday and today, I think some kind of pullback is going on. So buy here with a stop below day's low of 1860 for targets of 1930. A disclaimer, we have recommended both the stock to our clients and have positions in the option segment. So there's vested interest in both these stocks.
Okay, all right. Thanks a lot for that, Mitesh. Well, the markets are still down. We're down close to under 120 points. But, if my director can pull up, Infosys and Reliance Industries, they seem to be trying to put in a bit of a fight. And that's why we've recovered close to around 40 points from the day's low. Just take a look at the intraday chart out there. Both of them, they're putting their hand up and trying to be counted. The problem is the Nifty Bank continues to see weakness. It's down 350 points out. Well, time to focus on a couple of stocks that are moving around. Abhishek's back with us to tell us about Muthoot Finance. Abhishek.
Well, the AUM growth for Muthoot Finance was strong at around 19% YOY, which is perhaps one of the best in last 8 quarters, and 7% sequentially. The gold AUM growth is also strong at 17.5% YOY and about 6.7% sequentially. Calculation shows that the average ticket size might have increased by about 12% YOY and 5% sequentially. The net interest margin has dipped a bit to 11.58% when compared to 12.26% in the previous quarter, and home finance subsidiary that saw sharp stock consumption of capital. Capital adequacy ratio is down to 52% when compared to 66% in the previous quarter. Belstar MFI, the AUM growth is strong over there, 49% growth YOY and about 13% sequentially. However, we have a downgrade coming in from Morgan Stanley. They have downgraded Muthoot Finance to underweight from equal weight. Target price has been cut to 1,150 per share. They say that the gold price rise has driven the Muthoot's loan growth this time around. Stock now appears to be consolidating. Structural risk is there to gold loan growth and yields from competition remain. So they have reduced FY24 to 26 consolidated net interest margin to about 11.7% when compared to 12.3% that they had earlier. And they have also cut down the standalone EPS estimate over the next 3 years anywhere between 3.6% to as high as 6.6%. Back to you.
Okay, thank you very much for that. Nykaa is the other one on our radar. Mangalam joins in. Mangalam?
Well, Nykaa is down 8%, and here's 5 reasons why. The first one, in their first quarter numbers, it was the weakness that in the fashion business, gross merchandise value, that's impacted their overall performance. So the overall GMV in the first quarter was up 24%, but the fashion business saw a growth of just around 12% year on year, and quarter on quarter there was a decline of 1.5%. That's not all. The contribution margins of the fashion business also declined by about 50 basis points as the company upped their marketing spends. The second reason, lower ad revenue. The company got lower ad revenue on its platform. There was a pullback in ad spends coming in from all the D2C players because of a funding winter coming in. The third reason, eB2B business, which is their superstore business, saw an impact of nearly 90 basis points on the gross margins because of the product mix. Fourth reason was brokerage downgrades. So Nomura, for instance, has downgraded the stock to neutral, cut the target price at around to 163 rupees per share as well. And the fifth reason, valuations. The stock hasn't done much in the last 1 year or so from a point-to-point basis, but still trades at around 4.5 times 2-year forward price to sales. So that is something that perhaps the street is not very comfortable with.
Okay, Mangalam, nicely and neatly summarized. Thanks very much. That's Nykaa in focus. ABB is the next one. Vivek has got details. Vivek.
Well, ABB India clearly appears to be a case of, the stock actually selling off on good numbers. If you're comparing the numbers versus the consolidated estimates as well as our own estimates, our numbers were a clear beat. Even the order inflow, in fact, the only sore point would be the fact that the company's base orders grew only around 4%. The order book growth was higher this time around, largely aided by a one-time, the order that the company received from a large metal company. But if you're looking at the numbers themselves, double-digit profitability as well as revenue growth. Revenues higher by almost 22% on a year-on-year basis, in line with the estimates. Strong operational performance, so EBITDA margins coming in at 13.9% versus 12% this time around. Profitability higher, against a pool of 247 crore, coming in at close to 295 crore. When you're talking about the core order book, standing in at this time around, standing in above 7,700 crore. However, Kotak Institutional Equities has gone ahead and downgraded the stock. What they're saying at this point of time, despite good Q1, the valuation at this point of time is not giving a comfort, which is what is driving the downgrade at this point of time.
Okay, all right, Vivek, thanks very much for that. So that's ABB down despite decent numbers. We'll take a quick commercial break here. We have Saurabh Mashruwala, Chief Financial Officer at Torrent Power, who will be joining in for a quick discussion on their first quarter numbers. Stay tuned.
Welcome back. The Nifty is now above 19,300. It's been a recovery of close to about 70 points from the day's low. And one important support level to track will be the 20-day moving average on the Nifty. We got quite close to it. 19,240 is the, 50-day moving average. 50-day moving average is 19,240. The markets went close to it, but from there it's rebounded, aided by Reliance and Infosys. But let's talk commodities. Manisha is with us. Manisha.
Thank you so much for that. I'm looking at the gold prices today, which are trading at around 1 month lows. We have seen 3 weeks of constant decline coming in for the gold prices. And the weakness comes in on the back of strength in US dollar, which has seen an uptrend for the last 4 weeks. You also have seen strong treasury yields. The markets also are dealing with high inflation numbers that we saw come in from US, and all of that is weighing onto the markets. I want to tell you on what we've done on a week-on-week and a month-on-month basis. So in the last 1 week, the gold prices have declined by nearly 1.5%, while silver prices fell by 2.5% in the same time. In the last 1 month as well, both the commodities have posted negative returns, with gold down 2.5% and silver down 10% as well. And now when you look at the volatility that we have seen in case of gold prices for the year, we started this year with 1823. We did see 1810 off a low by the month of Feb, and then we saw a high of 2051 by the month of May, and currently trading at 1910, with the street anticipating if we continue to see higher inflation, another rate hike from US, then you perhaps are looking at 1900 reaching on the lower side as well. So while the returns in the very near term may not have done well for you, but the markets definitely seem to be buying into these declines. For the first half of this year, we've seen global central banks go on a rampage. This is the highest record ever in the first half of an year that you have seen this kind of a buying come in from central banks at around nearly 357 tons. Last year was a record buying as well at 1136 tons by the global central banks. So whether it has been about Russia, China, Turkey, Kazakhstan, many European countries, even India for that matter, we have seen our buying increase as well. And as of now, our gold reserves hold 8.17% of its total at 797 tons. So India has been buying gold as well. And you look at the gold ETF buying within India, and June and July have been very strong months. It has been net flows of inflows of around 456 crores as compared to 70 crores last month. So on a month-on-month basis, we have seen a very strong jump, and this is only because the gold prices have corrected slightly on the weaker side there. But this is going to be a data-heavy week yet again. In this week itself, we are looking from industrial production, retail sales to housing numbers coming in from China and from US as well. You will be watching out for the retail sales numbers. It also is going to be about the US Fed minutes this week as well, and that's what will give further cues for the market.
All right, Manisha, thanks very much for that. So that is the commodity picture. Well, you know, I saw that flash on PVR Inox, highest ever weekend collections. So that is quite something. I mean,
Going for a movie today?
I don't know.
I'm trying to.
You were trying to? Which one, Gadar?
Yeah. I've not even seen the Rocky and Rani. I'm Bollywood, so you know, I'm keen.
You know, it's kind of it boggles my mind that Gadar, the first one, came out in 2001.
Yeah.
Wow.
You know? It's been so long. It just seems, it doesn't seem like that. I thought, well, it must be 10 years, 50. And I love that movie. And the second one, of course, I mean, which is now out, which is, I guess, responsible for this blockbuster collections. Yeah. That was incredible. And I read somewhere that Sunny Deol is now closer to 65 plus. I mean, I don't know the exact age, but that's incredible.
Still the macho man in him. And you know, what about in North India? Parts of North India, they're going to watch the movie on the tractor. Amazing. Now, you can't beat Punjabis. I just love that.
All right, well, we'll take a quick commercial break. Do we take that break? No, we don't take that break. We have a very special conversation now lined up. Torrent Power Management is with us. I mean, you rarely, very few times you see them on television. This is one of those times. The company reported a steady set of the first quarter numbers. Revenues and EBITDA witnessed good growth, while margins were stable at 16%. Saurabh Mashruwala is Chief Financial Officer at Torrent Power. He's joining us to take some questions. Saurabh, great to have you with us here. Appreciate your time here on CNBC-TV18. Prashant this side. You know, I just want to start with just a quick comment, and I want to ask you to comment on each of these things. So you had your distribution business, which was flat in the quarter which went by. On the renewable side, numbers were a little subdued. I was reading that maybe that cyclone did some damage. The thermal numbers were strong, but that was largely on the back of merchant sales. So just a quick comment, one line each on each of these segments, and how do you see them panning out as we go ahead? Go on.
As far as distribution is concerned, yes, you are right. Is that it's a stable business. In fact, we have two categories of distribution business. One is license business and one is franchisee business. License business is a more or less stable business. We earn the regulatory returns as well as efficiency gain. And franchisee business, yes, it's a non-regulated business. So we make profit out of the volume gains as well as reduction in AT&C losses. So historically, we have a good track record of improving the AT&C losses across all our distribution business. So if you look at our license distribution business, our AT&C loss is sub 4%. This is remarkable, I would say, compared to global benchmark. And as far as franchise distribution business is concerned, Agra and Bhiwandi are difficult territories. We are able to turn around them, and our AT&C losses is sub 10%, I would say, and which was about more than 50% when we took it over in long back, I would say. In terms of our new acquisitions, SMK, Sil Bumrah and Kalwa, we are able to reduce the distribution losses, AT&C losses, from 55% when we took it over about 3 years before to about 33%. So we have a remarkable show in terms of reduction in distribution losses across all our distribution segments. So which is one of the contributors, I would say, for the current quarter. Apart from that, we have a thermal generation where in the current quarter, we are able to participate in the government scheme for supplying power for the gas from the gas-based power project, which has contributed about 145 crores, I would say, from the sale of LNG trading as well as sale of merchant power, which was about 80 crores last year, a similar quarter. So that has also contributed significantly in our bottom line for the current quarter. In terms of renewables, yes, renewables, we are growing. Opportunity is pretty large. The government has a target to achieve our 500 gigawatt of renewable capacity by 2030. So it's a very large opportunity for all the players in the industry. And so we are also very active in the renewable segments also. We have about a 2 gigawatt of renewable capacity operational as well as under construction capacity. We are very recently ventured into the C&I segment, which is very promising segment, where C&I consume about 50% of the electricity in India, and RE penetration for these renewable segment is less than 5%. So it plays a very good opportunity for us. So we are actively considering that segment also. We have about 165 megawatt of renewable capacity, C&I capacity in the development right now. So in terms of other area, we are also very recently got into hydro storage facilities also, where we got some MOU signed with the Maharashtra government, about 5.7 gigawatt. So these are the renewable segment where we are also looking at the hydrogen segments also. We have started pilot project of blending the hydrogen in our Gorakhpur distribution CGD area of Torrent Gas Limited.
So just speaking on each of these segments individually, with the thermal part, there is some concern in the analyst community that the merchant power sales, which have gone up significantly, as you pointed out, I think from 80 crore it's come to about 140 crore. It may not be sustainable going forward. What's the current run rate of merchant power sales according to you?
The merchant power, it depends on the gas price available, LNG price, I would say. So depending upon the LNG price, we generally do the merchant sale. As far as the gas situation is concerned, it is more or less stable now. It's coming to $10 to $12 kind of a thing. So we are upbeat about the merchant sales also, but it all depends on the availability of gas at affordable price.
All right. Saurav, hi, good morning. Nigel on this side. Well, you've highlighted interest in opportunistic M&A, I think, particularly in the distribution business and renewable energy as well. Have you identified any potential targets that you're looking at?
So in terms of distribution, as you know, we have last year acquired Union Territory of Daman and Diu. So we are performing exceedingly well in Daman and Diu area. Top of it, we have been allocated parallel license in Mandal Becharaji region in Gujarat also. So that also is coming up for it will be operational very soon, I would say. Top of it, we have been there in Dholera SEZ also. Dholera, the special economic investment region also. It's a long-term opportunity for us in Dholera, and it's a very government is trying to develop as a manufacturing hub. So their opportunity will also is a long-term opportunity we are looking at right now. In terms of franchise distribution business, we are awaiting the more franchise to come on the board. Plus, we are awaiting the announcement of the Union Territory of Pondicherry, Daman, Jammu and Kashmir also. The state of Goa is also going for the private election. We are very keen to participate in all those opportunities.
What is the ballpark number you'll have to spend, sir, for these opportunities that you're looking at?
If you look at the distribution investment, is a gradual investment, it's nothing not like your thermal investment or renewable investment, where you have to invest a very upfront amount. But distribution is a very phased manner. You have to invest every year, and then you have to upgrade the network. So investment in distribution is in a phased manner, not like thermal generation or renewable generations investment.
Okay, all right. Got that. You've said that you want to reach 5 gigawatt of capacity over the next 5 years. You're at about 4.1. I think about 65% of which is I think gas based. Could you tell us what will be the targeted mode of expansion? I mean, how will you get to this number?
So we have an ambition to reach 5 gigawatt of renewable capacity in next 4-5 years period. Currently, we are at 2 gigawatts right now, including the under development capacity. So we are looking at various areas, including the all RE spectrum. We are looking at with solar, wind, hybrid. Also, we are looking at. We are also started looking at the CNI segment also, as well as farm hydro also. So all this segment, we expect that in the next 4-5 years, we are able to reach about 5 gigawatt of renewable capacities. We have started acquiring lands also, as well as we are making applications for the evacuation facility also.
Okay. That tie-up with the government of Maharashtra, you said was the hydro. That's for pump storage, sir?
Pump storage hydro. If you look at the pump storage hydro, there is no better storage solution available in India. So there are two kind of solutions available, one is the battery storage as well as one pump storage hydro. Globally, about 90% of the storage facility is available from the pump storage. So battery storage is bit costly as of now. It's not mature right now at this moment. So pump storage is a well-established, I would say, and a proven technology where we are going to participate in pump storage going forward. So we are in fact in discussion with the other state government like UP, MP, Rajasthan and Gujarat, so that we can take more project in those areas also.
Okay, all right. We'll leave it there. Saurabh, great to have you with us here. Thank you very much for joining us and appreciate you coming on and providing us with all of those details. We'll take a quick commercial break here. With the news of the market still there, I mean, holding the 19,300 kind of level, 19,315, 113 points down. We have the management of Galaxy Surfactants joining in to talk about their quarter and how things are looking for the company. Stay tuned.
Welcome back. The next corporate on our radar is Galaxy Surfactants. The company has saw, across geographies and segments, there was a bit of a weakness. So the top line growth for the company in the current quarter has declined by 18.7%. While there is a volume growth of 7.5%, there was a decline in the EBITDA per ton, and that led to the overall top line contraction of 18 to 19%. Yu Shekhar, the founder and promoter managing director at the company, is with us on the show now. Morning, and thanks for joining in. This is Rima here. So what can you guide on volumes and on the realization, the EBITDA per ton going ahead? What are the key trends that you're observing?
So we have seen approximately 7% volume growth rate. And this is particularly significant because the last 2 years have more or less been flat. And this volume growth has been entirely driven by the robust and buoyant economy in India. We have experienced a double-digit growth in India, whereas consumption has been significantly impacted in the rest of the world, including Africa, Middle East, and Turkey, Europe, and America, due to persistent inflation. So India has been a very, very good, growth story. We do see certain green shoots in Europe as well as the Africa, Middle East region. So we are confident that the coming quarters should be similar to the quarter that we have seen now. So we should expect a similar performance to continue for the rest of the year.
All right. Hi, good morning, Mr. Shekhar. So for the year, you're saying that you'll have a volume growth of around 6 to 8%, and also
right.
what could the EBITDA per ton look like? Okay, volume growth you've got 6 to 8% for the year. You're maintaining that. EBITDA per ton, what will it look like for the year?
The EBITDA per ton, as I said, we have not given any sort of guidance with respect to that. However, we have said that we will see or we will aim for an EBITDA growth compared to last year.
Okay. All right. So good morning. So you said rest of the world is still hurting, right? So the high margin specialty surfactant segment is still doing poorly.
Yeah, the high margin and specialty segment certainly has been doing not as good as it has been, though we have seen that there has been a growth year on year this quarter compared to the last year. Though on quarter we have seen the volumes as good as flat. Fundamentally, what we have seen is the inflation in the developed countries has made the consumers focus only on basic necessities, on mass and mass-produced products, whereas the discretionary expenditure has been significantly impacted. So we do see, we have seen the specialties growing certainly better than compared to last year, and we do expect the consumption to come back as the inflation eases, which we do see happening in Europe. You know, Europe, the prices have moderated compared to what it was last year.
So do you think Europe can report a volume growth at least in Q2, or is it going to be an H2 story? And what about the rest of the regions, right? Africa, Middle East, Turkey, North America. You're talking about green shoots. Can you break them up in individual segments, in the individual geographies? When can we expect a volume growth or a pickup?
We do see some green shoots in, Asia other than China, other parts of Asia other than China. We have seen certain green shoots in Europe. Similarly, we were seeing it in Africa, Middle East, and Turkey, but suddenly we have seen a resurge of inflation in Egypt and Turkey in the last week or so. So this volatility is something that can impact consumption, but we would like to remain hopeful and confident.
All right, Mr. Shekhar, give us a couple of numbers then. Value-added products as a percentage of revenues, how much is it now?
When you say value-added products as a percentage of revenue?
You must be having particular amount of your total sales mix that are higher value, right? Which maybe get better margins. Is that the case?
You are talking about specialties. See, specialties have always contributed to approximately 1/3 of our total sales in terms of volume. Sorry, in terms of value. In terms of value, yeah.
Where is that number headed?
Now, that would remain more or less the same going forward, because what has happened in the last 2 years, where people have shifted to the basic necessities, that is mass and masstige products, the performance products have been the category which has been performing. Okay? So when you talk about again this quarter, the performance products have performed, have seen the growth, whereas the specialties have seen a minor decline compared to last year on an overall basis.
Okay, all right. And what is your current capacity utilization levels? I recall that you increased capacity by nearly 50%, in the last 5 years. I think between...
It's in the region of approximately 68 to 70%.
Got it.
All right, Mr. Shekhar, appreciate you joining in, sir. Great speaking with you, and thank you very much once again for joining us here on the program. Well, we are down 100 points on the Nifty, so 19,312 is where we are at. Well, that's a wrap on this edition of Bazaar. From all of us here in the production team, thank you very much for staying with us. Wishing all of you a happy Independence Day once again. So programming continues. Stay with us. We're coming back right after this break.